Hello, welcome back, and thanks for joining us for our first session of today. We've just had a wonderful keynote address by Lord Macpherson, who emphasized the institutional frameworks that central banks operate under and how that shapes their decision making. So we've now got a panel, we've now got a paper session, that's going to delve into these issues further. We have two excellent papers that are going to look at governance issues, decision-making issues, communication issues of central banks. Our first speaker is, I'm delighted to say, is woken up very early from Washington to join us, is Juan Londono from the Fed board. So Juan, I'll pass the floor to you. You have 20 minutes to present. Over to you.
Great. Thanks so much, David, for inviting me. And I'm happy to present this. I would have preferred to be with you guys in person. But so, yeah, I'm going to be presenting a paper that's called Financial Stability Governance and Central Bank Communication. And this is a joint work with Ricardo Correa, who's at the board, and Stijn, who's at the BIS. And the usual disclaimer applies that these views do not represent those of the BIS or the Federal Reserve. Let's go to the next slide. So let me summarize in one slide what we do in this paper. I wrote with Ricardo a paper that was published earlier last year about communication by central banks about financial stability, that is in the financial stability reports. And we found that that sentiment had predictive power for the future movements in financial cycle indicators. I was also a good predictor of banking crisis. So what we do in this paper is something related but completely different. We're going to try to explore a little bit more the heterogeneity, and in particular how differences in governance frameworks explain these banks' financial stability communication strategies, how they also can use other instruments, including macroprudential policies, and the effect that these joint strategies have on the evolution of the financial cycle. Next slide. I'm not going to do a lot of the literature review because I think some of these authors are in the room, but basically what we're going to try to do in this paper is bridge a gap between two literatures. One is on financial stability governance framework, and the other one is a big literature on communication by central banks. But in this case, we're only going to focus on communication about financial stability, which is a literature that, well, basically by construction is relatively young because central banks started writing financial stability reports in most countries in the mid-2000s. The Bank of England started much earlier than that. And I think almost all central banks started writing reports right after the global financial crisis. So let's go to the next slide. So what I'm going to do in this paper is merge three different types of databases. I'm going to have governance characteristics of each central bank interact with the text in their financial stability reports, which is going to be my second database. And the third database is going to be a database that we use as characteristics of the financial cycle, including our own definition of financial crisis. So what we have here is a snapshot of how governance characteristics look like in 2017. I'm going to focus the attention on three characteristics: whether the central bank participates in a financial stability committee, whether that committee has powers, and whether the central bank has an oversight role for the financial institutions in the country. As you can see, we have a little bit of everything. That is, central banks that have just one of the characteristics, interactions between two or three characteristics, like it's the case for Austria and the UK, and central banks that, like Poland, that by 2017 did not have any of these characteristics. Let's go to the next slide. As promised, the second database that we're going to have interacting with governance frameworks has to do with financial stability communications. And the main source for this is going to be the text in these central banks' financial stability reports. If they publish it officially in English, that is, whether it's published in English or officially translated to English, we do not translate financial stability reports. We have reports for 24 banks, and we have a sample that started in 2005. The way we calculate sentiment index is quite simple, and by now somewhat standard in the literature, is the proportion of negative to positive words. And how do we know if a word is positive or negative? Where we use the dictionary that we constructed for financial stability in our previous paper. The words and the whole dictionary is in my website, and we also have the time series of the financial stability sentiment indexes there if you guys are interested. Let's go to the next slide. This is a plot of the financial stability indexes aggregated across all countries. And what I did here was basically to separate in two groups. The figure to the left has a plot of the aggregate index for the banks with a committee and not participating in that committee. The figure to the right is the banks with a financial stability mandate and those that don't have a mandate. I think it's hard to see the difference between these two, but I want to give you at least an idea of how these indexes behave. Remember that this index was the relation of negative to positive words. That means that an increase in the index is going to be a deterioration in the index. The dynamics are pretty much as expected and sort of validate our dictionary and the methodology in that sentiment deteriorates a lot around the 2008 global financial crisis, and then you see sentiment deteriorating a lot again around the European crisis and other episodes. These small differences in how central banks behave that are hard to see when you aggregate is basically what's going to tell you whether central banks deteriorate their sentiment more, or maybe they deteriorate their sentiment earlier when they see a crisis coming. Let's go to the next slide. And the final database that I mentioned is a set of characteristics of financial stability conditions. And we're going to have two types of characteristics. One has to do with slow-moving variables, and these are credit to GDP gap, debt service ratio, and total credit to the non-financial sector. These are variables that are available at a relatively lower frequency, but so are our financial stability reports. So that's not going to be an issue. But we're also going to include some more high-frequency variables that are available, some of them even daily, but in most cases monthly. CDS spreads, S-risk to GDP ratio, which is going to be our proxy for systemic risk, and some measures of valuation pressure, especially for the housing sector. And these are the variables that we're going to use to see how central banks sort of digest information that they receive from outside. And since we're also going to center a lot of the attention on how central banks behave around turning points in the financial cycle, we're going to make our own definition of crisis, given that we do not really have many crises in our sample. These are going to be defined as turning points in credit to GDP gap. And the way we calculate it is very simple. It's just the local maximum followed by 1 year drop in the gap. So as expected, all of the central banks most of the countries in our sample experienced one of these sort of mini financial crises during the global financial crisis of 2008, and most of the European central banks experienced one around 2011 or 2012. So let's go to the next slide. So I'm going to summarize what we do in the paper now that we understand the databases in a cartoon. We do not have the cartoon in the paper, so I do have a more structural version of this cartoon, but I think it gives you an idea of what we do. So the central bank, the chair of the central bank, is in charge of basically taking care of the financial institutions in the country, which are the sheep, and the wolf is here or can come. And the central bank has many tools, including central bank communication about financial stability. So the strategy of the central bank is how close the wolf was when they use this communication, and whether the message that they send is credible, right? Whether they cry wolf too often, for example, and then people don't believe them anymore, or the central bank is transparent or not. And how do we know if communication is effective? Well, when the wolf is gone, or when the wolf does not cause any damage. So let's go to the next slide, and I'll show you what we actually show in the paper, but it's basically the same. So it's a very simple structural framework that has 3 periods of how we should think about central bank communication. So in period 1, the central bank of any country observes a set of initial conditions. The central bank can receive public information, but can also receive private information. Think, for example, of central banks that are in charge of oversight. They're going to have much better information about the health of the institutions in the country. So it receives this set of financial conditions, FSIT, in period T, and it's going to form expectations about how the final the conditions are going to evolve in our third period, which is going to be T plus H. Let's go to the next slide, and I'll show you what happens in period 2, which we call T plus L. So the central bank is basically going to use a battery of tools, and one of them where we're going to center the attention is communication. So the communication strategy is going to be that the bank is going to say something about current conditions, so the conditions at T plus L, and about the evolution of the conditions, so FSS at T plus H. Now, what is the communication strategy of a bank? That the central bank can send sort of mixed signals. For example, the set of what the central bank communicates about how things are today, FSS in T plus L, could differ from what the central bank actually observed in T, FST. and or the central bank can communicate its expectations about the future FSS T plus H that are different from the actual sort of internal expectation, which is the expectation of the central bank. And this can be especially true about financial crisis. Think, for example, of a central bank that has two scenarios. One is that the central bank has other tools, such as monetary policy and macroprudential tools. So it believes that the current expectations of that things are going to be really bad in the future, but the central bank can do something to prevent them. So what's going to say is like, don't worry, we're going to make it because we have other tools. Another thing that could happen is that the central bank is simply not transparent because it's either not independent or it doesn't have the resources. So what it communicates about the future has basically nothing to do with what it observes today. Let's go to the third slide. The third period, yeah. So in period 3, which is T plus H, what's going to happen is financial conditions are going to evolve depending on the previous conditions, the tools implemented by the central banks, and of course, shocks that occur at that period. And for simplicity, we're also going to have two possibilities. With probability pi, the financial conditions are going to be good, FS up, and with a probability 1 minus pi, the financial conditions are going to be bad, or let's call it a crisis. So we're going to say that a bank is effective at communicating or at using other tools when it is able to sort of minimize this probability 1 minus pi, the probability of a crisis. Let's go to the next slide. So hopefully I'm going to be able to go through all these things. Let's go to the next slide and talk about the effects of financial stability conditional on a governance framework. So the goal here is to see whether once we have interact financial stability communication and macroprudential, and governance frameworks, we're going to have an effect of communication over the evolution of the financial cycle. As I mentioned, we're going to use a sample of 24 countries between 2005 and 2019. We're right now updating all the information for financial stability reports. So hopefully we're going to have some COVID effects in the next draft of the paper. Let's go to the next slide. So the empirical setting that we used to sort of validate the first part of the hypothesis of the banks, whether the central bank is effective at communicating depending on the governance framework, is really simple. So the left-hand side variable is going to be a variable that tells us something about the evolution of the financial cycle. In this case, for example, credit to GDP growth in the future, that is 4 quarters for today. And what we have in the right is the financial stability sentiment in central bank's report, FSS. And we're going to have it interact with a dummy that takes the value of 1, whether the central bank participates in a committee, that committee has powers, or has an oversight role. So it's a very simple setting. And of course, all the attention is going to be centered around this beta 2 coefficient. And what we see in the table is that beta 2 coefficient is negative and significant for central banks participating in a financial stability committee. And moreover, if you look at beta 1 plus beta 2, which is the coefficient associated with those central banks that have a committee, it's also negative. So how do we interpret a negative coefficient here? In this case, would be that credit to GDP is smaller in countries that communicate negative sentiment. So an increase in sentiment, which is a deterioration in the sentiment, is followed by a decrease in credit to GDP gap. So the central bank is, the interpretation would be that the central bank is able to alleviate the deterioration of financial cycle. The results that we have in the paper show that this is consistent if we look at other indicators such as debt service ratio and credit growth. Let's go to the next slide. Now, one could say that, well, maybe you're getting that committee is important because you don't have other variables, and there could be other variables explaining this communication effectiveness. So what we're going to do is keep the setting, but we're going to add an X in this setting, and this X is going to be any other characteristic that we could think could affect communication strategies. And we include transparency, independence, financial openness, foreign bank ownership, bank international claims, and whether the English is one of the native languages of the country. So what could happen here that once you include another variable, well, the effect of the committee disappears. And as you can see here, the beta 2 continues to be negative, and the beta 3, which is the one associated with this variable, is just not significant. So that means that having a financial committee is the variable that matters really for the effectiveness of communication. So let's go to the next slide. Another thing that we thought is, which is more related to the cartoon, is that communication can be slightly different when we're approaching a crisis. So what we're going to do here is add not another characteristic, but an event. And in this case, it's going to be a dummy that takes a value of 1 if we are approaching a financial crisis. So this is that variable C. So beta 4 is going to be the interaction between being a crisis and having a committee in this case. And that's the variable of interest here. And that variable is negative and significant, and that means that sentiment is more correlated with gap-around crisis, but less so, and that's the beta 4 coefficient, for central banks in committee, especially with power. So they're even going to be a little bit more negatively related between being in a committee and being before a crisis. Let's go to the next slide. And one thing that one could also do is not only have the interaction between characteristics and being before a crisis, but whether you can actually predict those crises. So we're going to switch to a setting that is a probit. This variable C takes a value of 1 if there is a crisis, as we've seen before, and we're going to see if communication is effective at predicting crisis or not. I'm going to show you the results for the simple setting with no control variables. In the paper, we have a lot of robustness tests. So we're going to separate the central banks into whether they have a characteristic or not, for example, a committee or not, a committee with powers or not. And I think the main result of this table is actually the one for central banks that do not have the characteristics. So if you look at the column that says no, not having any of the characteristics, you always get a positive and significant coefficient. And this is highly correlated with what we had in our previous paper. And this basically means that when sentiment deteriorates, the probability of a crisis increases. So that means that central banks are very good predictors. So they cry wolf, and the wolf actually comes. The thing is, like, whether this is what we want for a central bank to be a good predictor. One could think that a successful central bank is the one where sentiment deteriorates and the probability of a crisis actually decreases, which is what we observe for banks that participate in a committee with powers. Now, I have a disclaimer here is that this setting is not bulletproof. And one potential problem that we have is identification. Think of a very successful central bank that will be able to always curtail crisis. Then for that particular central bank, we're not going to observe crisis, and it's going to be impossible for us to see whether communication has a strategy. Interestingly enough, for our sample, we do not observe this mini crisis for Germany, for instance. So I think that's an identification limitation given the data that we have, but we do the best that we can, and we, in theory, won't observe this for the banks that don't have any of the characteristics. Let's go to the next slide. So now we know that central banks that participate in a committee, especially in a committee with powers, are better to sort of alleviate the deterioration of the financial cycle, and they seem to be better predictors of crisis in the sense that they reduce the probability of a crisis. So in the rest of the paper, what we do is investigate communication strategies. So what makes these central banks more effective than others? So what we're going to do here is assess whether communication strategies, depending on the governance framework, differ across the financial cycle, and whether the central banks use other instruments coherently with what they communicate. Let's go to the next slide. So the setting is pretty similar to the other one, but since we're talking about communication strategy, our left-hand side variable in this case is the text in financial stability reports, the sentiment. And the variables to the right is whatever the central bank uses as inputs for the communication. And in this case, I'm only going to show you the result for a new index that we calculate in the paper, because this is something that we did relatively like just a few months ago. And it's a sentiment index that is calculated using Thomson Reuters news database for articles that talk about financial stability in English for each country. So basically, this tells us an aggregate of whatever it's available in the media to central banks. In the paper, we do something a little bit more sophisticated, is that we not only include what is in the news, but also the other indicators, for example, CDS spreads and valuation ratio. But basically, what we want to see here is the relation between sentiment in reports, sentiment in the news, and how these things interact with the governance characteristics. So how do we interpret the coefficient here? So beta 1 is the coefficient associated with central banks that do not have any of these characteristics. And this is good news, basically, because it's positive and significant, and that means that whatever the central banks and we observe in the news is positively related with what the central banks are saying in the report. So that means the reports are not just saying something completely different from what you would read in the news. However, for central banks in a committee, and this is the additional effect of having a committee, the beta 2, the coefficient is negative and significant. So the way we interpret, and beta 1 plus beta 2, which is the total coefficient of central banks in a committee, is still positive. So the central banks are still in line with what you observe in the news, but less so than for central banks in countries that don't participate in a committee. So the way we interpret this in the paper is that central banks that participate in a committee tend to send a calmer message after they observe a deterioration in the news. And then that was a little bit puzzle for us at the beginning. Why is it that these central banks, instead of sort of yelling, crying wolf louder they tend to sort of say, we're going to make it, or send a toned down message. So that's what we do in the next slide. Let's go to that one. And it's investigate potential hypotheses of why central banks are sending a calmer message. And our main hypothesis is that central banks are going to send a calmer message because they have the ability to implement other prudential policies. Remember that another hypothesis was that the central banks just made a decision not to be transparent. So another thing we can do, obviously, is to test whether transparency matters for this. But for now, we're going to test the hypothesis that matters for governance framework. So how do we know if central banks are implementing macroprudential tools and they're making these tools coherent with what they communicate? So this is what we call coherence test in the paper. So the left-hand side variable in this case is an index of macroprudential policy implementation that was constructed by Ricardo and Eugenio Cerruti at the IMF. And what we're going to ask is whether a deterioration in sentiment, which is the variable to the left, to the right, is followed by a coherent implementation of more macroprudential tools. And what we observe, if you look at coefficient beta 2, is that indeed, for central banks participating in a committee, and especially for those that have the powers to implement these tools, a deterioration in sentiment is followed by a higher numbers of macroprudential policies. And this is what we call, well, these central banks are being coherent. They have the ability to implement the tools, and they're actually doing it after they say so. Let's go to the next slide. So I think I want to conclude here by telling you the summary of what we find in the paper. I think I have enough time. Financial stability communication by central banks that participate in interagency financial stability committees are relatively more effective than these other central banks at alleviating the deterioration of financial conditions, especially at preventing crisis. And what is their communication strategy? Well, it seems to be that they send a message of calm relative to the other central bank. And how do we know that they send a calmer message? It's because their sentiment deteriorates less following a deterioration in new sentiment, and we obtain the same results for other indicators. And what explains this calmer message? Well, a partial explanation for this is that they have the ability to implement macroprudential policies, and they're acting coherently by implementing these policies. So we've been updating the paper. That's why it's not available on the website. We're actually right now revamping the paper. So the comments are going to be very useful. Thanks again, David. And I'm looking forward to hear the comments. Thank you.
Wonderful. Thank you very much, Juan. That was a really clear and super fascinating presentation. Okay, so our discussant is Stephen Hansen from Imperial College Business School. Stephen, I think your slides are up, so over to you.
Yeah, sorry, I see the host unmuted me, that's fine. Yeah, thank you. I assume that I was asked to discuss this paper because I've sort of worked in the organization of central banks and also central bank communication, but I have to admit that I know a little bit less about kind of finance issues than monetary policy issues. So some of my comments may just reflect my ignorance, but I thought they were, still useful to share. So given my background, where I came into this paper was via this sort of broad interest that's currently going on in central bank communication. So I think we all know that central bank communication has become important. But what I was less clear on is the role of communication and financial stability. So when it comes to monetary policy, I understand that when interest rates hit the zero lower bound, communication was sort of all that was left to anchor market expectations. In this particular context of the central bank not implementing monetary policy, but sort of financial policy more broadly, I wasn't sort of exactly sure where the literature stands on the importance of communication and the extent to which we view communication as really a policy instrument versus the standard things banks might do in terms of kind of micro and macro prudential policies. So that was sort of one aspect of the background which I guess I'm ignorant on, but I would like to know more about. But be that as it may, I took the central argument of the paper to be that central banks that participate in interagency committees are better able to handle kind of emerging financial crises than other banks, and that their ability to communicate is linked to their effectiveness. Okay, so that's sort of the framework that I use to think about discussing the paper. So one thing I appreciated about the paper is this attempt to sort of write down a model of why communication matters. And that was sort of the central focus of the model. And I think Juan explained it very clearly. Again, the idea of the policy action that the central bank takes shows up in the empirics, but it didn't show up so much in the model, which really kept the emphasis on communication and why central banks choose the communication that they do, and how that depends on the information that they gather. So again, everything was sort of focused on the content of these financial stability reports. It was less clear to me how that interacted with the policy choices that these banks kind of ultimately take, okay? And at least the version of the model that I saw didn't really provide hypotheses for why governance patterns might be linked to different dynamics of communication and policy actions and their effectiveness. So I think the role of models and empirical work is to provide like very clear hypotheses that we can go test. And the key hypotheses of this paper seem to relate to the differential impact of communication with respect to governance frameworks. And there didn't really seem to be a model of that. So even if there's not a formal model, I think it might be useful to think about the channels through which we think governance might impact the effectiveness of communication and other policy tools. So I think, Juan discussed a little bit of the literature here, but when we think about governance in particular, I think it is important to separate out the impact that governance may have on financial stability apart from any particular communication strategies. So my main background in this actually comes through a PhD viva that I recently did for a student in Italy, Niccolo Fraccaroli, whose PhD thesis was basically arguing that interagency environments are correlated with more financial stability. So that's kind of very much in line with the message of this paper. But the channel there had nothing to do with communication. So the channel there was about regulatory capture. So when banks participate with other institutions in financial regulation, it's harder for banks to kind of capture financial regulators. Financial regulators do their job, and there's more financial stability. Okay, so I'm not saying that this story is more believable than the story of Juan and his co-authors. I just wanted to say that I think we can think about how governance impacts financial stability apart from the issue of communication. And so, that's sort of one more reason to kind of take a step back from communication and kind of think about more broadly how do we want to organize this space. All right, so in the last part of my discussion, I wanted to get kind of drill down a little bit more into the empirics of the paper. So here's the main regression from which the paper builds. So we basically want to explain future financial conditions as a function of current communication. So that's what this FSS variable is. And then we want to interact that with governance kind of characteristics of the central bank. Now, one thing I was a little bit confused about, it seems like there are two different specifications happening at the same time here. This is a fixed effects specification, which I'll come to in my next slide. And this is a kind of a cross-bank specification. So I wasn't totally sure which specification was actually run. I assume it was the fixed effect specification, and that's what I saw on the slides as well. So kind of one initial comment on this specification in line with my previous slide is, I think it would be useful to allow governance characteristics to have an independent effect on financial outcomes. So if you look at this specification, governance is being interacted with communication, but it's not allowed to have an independent impact. And I'm not entirely sure what the motivation for that assumption is. But let's think about this idea of including these bank fixed effects. So if you include a bank fixed effect, at least as far as I can understand, the correlations that we're capturing between governance characteristics and the effectiveness of central bank communication is really relying on changes in governance characteristics that are happening within banks, not across banks. And as the authors themselves say in their paper, there are sort of relatively few changes in governance frameworks within central banks. So it's not like central banks, in year T are in an interagency committee, and in year T+1 they're not, and in year T+2 they go back. So that made me think about, where is the variation in the data that's identifying this? In particular, there are some governance characteristics that are tested in the paper for which there seem to be really very few change points. So I forget now off the top of my head, but I think like there was an oversight variable or something like that for which maybe less than half of the central banks in the sample changed at all. And then, when they did change, it was a kind of a one-time event. So that's kind of a broad question about where the variation is coming from. I think one more important question is, do you have changes in governance that are two-way rather than one-way? So I would imagine, although I'm not sure, that there are kind of trends in how good governance is imagined. So maybe we think interagency setups are sort of better, and so there's a trend towards that. And so you have to be a little bit careful that you have transitions from one framework to another and back, so that these regressions are just picking up kind of time trends, where the changes in governance characteristics are sort of correlated with just all central banks becoming more effective at handling these things. All right, Juan didn't include these formulas on his presentation, but I've copied them from the paper. And this is from the model, okay? So the model explains communication. So this FSS, again, is the communication strategy that's being chosen by the central bank. That is a function of information that's publicly available and information that's privately available to the central bank, okay? So it seems very natural. This other equation relates financial stability, which is ultimately what the regression model is trying to explain with the communication. So we also think financial stability in the future is related to these signals that the central bank draws. So the model kind of defines an endogeneity between communication today and financial outcomes tomorrow via these signals. And I wasn't entirely clear in the econometrics where we were controlling for these objects. In particular, the private signals of the central bank seem very difficult to control for, and yet they're creating an endogeneity between these two variables that we're putting in the panel regression. So this kind of, sort of necessitates thinking a little bit more carefully about whether we're implying that there's some causal impact of central bank communication on financial stability that isn't driven by these variables that's not controlled for. I know my time is up. Let me make one more comment for 30 seconds. I wasn't clear on the measure of financial stability. And again, this could just be my ignorance, but this credit to GDP gap, I wasn't sure whether we should be thinking about that as a financial crisis event or a natural part of the dynamics of credit growth and credit contraction in a country. So in particular, the paper says that Hong Kong and Singapore had 9 separate turning points in this credit to GDP gap. I assume there weren't kind of 9 financial crises in Hong Kong and Singapore during this time. So I wondered whether we wanted to think a little more carefully about defining financial crises separately from the financial cycle more broadly. And now my time's really up, so I'll stop.
Stephen, that was fantastic. Thank you very, very much indeed. Juan, would you like to maybe take a couple of minutes to respond to those comments you've just received, and then we've got a bunch of Q&A that I'll relay to you.
Definitely, yeah. Now the sun is up, as you can see, so finally it's a little bit more light. Thanks so much, Stephen. I think the comments are really good, and this is the kind of thing that we're looking for at this point when we're revising the paper. I'm going to take your main comment as sort of the empirical part, and I think that's a very good comment. And we've been using sort of a setting that is similar to the one we used in the previous paper, but there we were more careful about the VAR setting. And here we should pay more attention about models with fixed effects and without. And I think I mean, I'm thinking about it, and this is exactly what we want. There is indeed not a lot of time variation in these variables. At least for the sample that we have, there are no changes back and forth. So it seems to be actually a trend. So all central banks seem to be converging to what we have sort of agreed that are best practices: participating in a committee, having a mandate, etc. I think that's the main comment. I think it is also good that we have to add more explanations to the model. At the beginning, we even debated whether we should add this framework. We never call it a model in the paper because it's not a model. I also do asset pricing models, and this is just a framework for us to think about it. But I agree that we should just describe the hypothesis earlier on. So this is going to be very interesting, and I'll send you an email. So if you can share the presentation. Thanks so much for your comments. And let me see if I can see the chat. Okay.
Yeah.
Good.
Well.
Oh,
So
David, yeah.
the Q&A, the organisers will bring them up and put it on the screen now. But there are questions from two of the other presenters actually in this session that maybe they can ask you first. So I wonder if in the background we can get firstly Michael MacMahon to ask his question.
Sure. Okay. Hopefully you can hear me. Yeah, really enjoyed that. My question kind of combines two of Stephen's comments, and you sort of emphasized, the extent to which central banks with power sort of could take action, and therefore that explained their different behavior. I wonder if there's a more organizational incentives issue. I mean, if you are a committee that's not only given oversight but also tools to prevent crises or try to prevent crises, and if you take seriously what Stephen was mentioning at the end, the sort of information effect, and you may want to sort of look to the monetary policy information effect literature for that kind of link, but I can imagine if you have the tools, you will be judged by whether or not you were successful at preventing crises. So you actually have an incentive not to release too much of a panic, because it could generate exactly the crisis that will look bad against your record. Whereas if you're simply in an oversight capacity, but you have no tools to address it, then you absolutely want to make sure that you were shouting loudly about all of the possible dangers, because you're not the one who has to prevent them. You're just there to say that you saw them coming. Anyway, just a thought.
David, do you want me to address one at a time, or?
Yeah, Michael Ehrmann, would you also like to pose your question at this point, and then we'll ask Juan to respond?
Sure, absolutely. Happy to come in. Thanks a lot. I really enjoyed that presentation. I think that's a great topic, great paper. You started off with showing us a snapshot of, I presume, current governance structures. Now, as Stephen pointed out in his discussion, the identification comes through variation over time, right? And I think we've seen quite a lot of that. I was wondering to what extent governance changes are endogenous. So do they come after crises, for example? And then in that sense, would these also be times when we invest a lot more in having better models to identify financial stability risks? These could also be times when markets listen much more carefully to what the central bank has to say. And so in that sense, to what extent are we picking up a time effect, which is sort of contemporaneous to a change in governance that you identify in your model that's particular sort of coming after financial crisis? Thank you.
Why don't you take those two questions, and then we'll look at the actual Q&A.
Yeah. I'm afraid I don't have good answers. I think this is very interesting. I think thanks to the Michaels. I thought Michael Ehrmann. Michael Ehrmann probably saw the previous one. Sorry about that. Yeah. So I like this idea of an incentive. In the paper we do mention that central banks that do not have, for example, an oversight role, they have to cry wolf louder to sort of warn the other agencies. So that's the role, because they do not have the tools directly. I have not thought about the opposite, which is if you do have the characteristic, then you have an incentive not to cause panic. So I think I'm definitely going to add that. And yeah, to Michael Ehrmann, I think we are definitely going to revise that, because the setting, because indeed most central banks start changing characteristics after the 2008 financial crisis. So it's when apparently they all find out that having a financial stability mandate and participating in interagency financial stability committees is it's a better practice. So there can be indeed a fixed effect there. It's not automatic. It's not like 2009 is the beginning of all central banks having the characteristics. Most of them start there. And so I guess if we have year fixed effects or things like that, I worry though that we don't have enough data points, but I think that's something we can definitely try.
Great. Okay, so there are three, I think, pretty interesting questions that hopefully you can see in the box. So these are questions from the audience. So I'll just summarize them briefly. So the first is by Gulchin Ozcan, who is asking you really about whether there's anything you can do to control for the remits that we're giving to these systemic risk committees, financial stability committees. It's not enough just to have a committee that exists, but how broad and how ambitious is its remit? So that's the first question. The second is by Juan Zambrano, who, Juan, if I understand your question correctly, you're asking about controlling for the other actions that the central bank might be taking around this time. Maybe there are monetary policy actions. Where does that fit into your analysis? Then the last one is by Timothy Foreman, who asks, I guess, around this kind of sentiment index you've created and whether, in addition to the overall sentiments, you can look at ambiguity or the degree of strength in feeling in these sentiments.
So let me take the first one first. So we do have in this database that was created by Nelly Liang, Rochelle, and Ricardo, and I think Eugenio, they've all participated in creating this database. We have other characteristics about the committees. We've tried some of them and they're pretty much the same results or not as interesting. For example, if the committee is official, so what they do is they read whether the committee is sort of an official, and another characteristic would be if the chair of the central banks or the governor of the central bank is also the chair of the Financial Stability Committee. And at first we thought those more specific variables were going to matter, and it seems like for our evidence, it just matters to be in a committee. So I think we're getting rid of those columns. I wonder whether we should bring it back to an appendix. So it doesn't really matter that much for the main result, which is that negative coefficient. And for Juan's question, actually, this is something that I didn't show in the presentation, but in the paper, we do have a setting in which we have the evolution of the financial cycle, communication, and we have tools as other right-hand side variables. And then we ask, the question there is whether communication is effective beyond the tools, and communication is still an effective communication strategy, even if you implement changes in monetary policy and the implementation of macroprudential tools. In fact, I think we do a test, and now I regret not having it as our last slide, in that has communication and current and future changes in monetary policy and macroprudential tools to see like if communication still plays a role, and it does still play a role, even if we sort of cheat a little bit and include these tools now and in the future. And the last one, we did not calculate this would be, instead of a sentiment index, I guess what you are suggesting, team, is an uncertainty index. We tried, and I guess now this is a little bit more important nowadays. I think this is something we could try. We have different indexes that we've calculated. They don't seem to matter that much. For example, we have a negativity index, in which we only count the negative words. And we have a forward-looking index in which we take into account words like should have, or words that say something about expectations. They don't seem to change the results at all. We've not calculated an uncertainty index. Now that I think about it, it should be relatively simple. If you do an EPU version of what we have, which is words about financial stability that convey sentiment, and if you have in the same sentence something related to uncertainty. But that's a good suggestion.
Excellent. Thank you very much. Well, you can see that attracted a lot of interest. So I hope that was useful as this work evolves, and we'll look forward to seeing future versions of the paper. So let's turn to the second paper in the session now, if we can. So our presenter will be Michael Ehrmann from the European Central Bank. Michael, if you can switch your camera on and your slides are up, so the floor's yours.
I'm coming in here. Thanks a lot. Thanks for having me at this great conference. It's really been very enjoyable. The paper here is joined with Robin Tietz and Bauke Visser. I'm the only central banker on that team, so there's a disclaimer down there. These are all my own personal views. In particular, because the ECB doesn't have a view on an institutional view on other central banks, and we're talking about another central bank here. So what we're interested in this paper, we want to understand how does having a voting right affect the behavior of committee members. And we're going to look at this for the case of the US Monetary Policy Committee, the FOMC. Now, the keynote address this morning already talked about the Bank of England's MPC. The Bank of England, the Federal Reserve are no exceptions. It's basically a rule that in most central banks nowadays, monetary policy decisions are taken by committees. And again, the keynote address already gave a couple of reasons. Basically, the idea is you want to make better decisions in a committee because you can aggregate diverse people, and so hopefully the outcome is better in the end. Now, of course, a committee is a team of human beings, and human beings are subject to biases, and there's frictions. So there's a long-standing literature on how committees work, and basically, some things that came up quite prominently are things like groupthink or social loafing that in the end lead to effects whereby the committee might not take the optimal decisions in the end. And so we want to come into this literature here with this paper by looking at the effect of voting right rotation effectively on behavior of committee members. And let me give you a little bit of background on this. So the FOMC has a voting right rotation already since 1943. It hasn't been changed since, and it's entirely mechanical. So I hope this will convince you, and I'll show you a slide about this, that voting right basically is exogenous to economic conditions. Now, the interesting thing here, it is a voting right rotation that comes without exclusion. And that makes monetary policy committees quite different from many other committees. Like, for example, if you're on the UN Security Council, either you have a voting right and then you're a member of the council, or you don't, and then you don't participate in the meetings. So in the FOMC, even a non-voting member participates in the meetings, in the discussions, just doesn't have the right to vote at the end. There are a couple of members who have permanent voting rights. These are the governors at the Board of Governors and the New York Fed president. And then there's 11 remaining Reserve Bank presidents who share 4 voting seats. I mean, they all have a seat at the table, but only 4 of them are allowed to vote. And the rotation is basically annual. So there's a couple of groups where 3 Reserve Bank presidents share 1 vote. So every 3 years, they would be able to vote. Cleveland and Chicago actually have a vote every 2nd year. Now, we're only going to be focusing on the reserve presidents that are part of this voting right rotation. So we will not look at the governors nor at the New York Fed president. Now, there's already a long literature which sort of looks at the behavior of these regional Fed presidents. And that literature, which was started by Alan Mead in the early 2000s, basically argues that they look very strongly at regional economic conditions. In particular, the variable that came out in empirical studies most prominently was unemployment. And it's been shown that regional unemployment affects the speeches of these Federal Reserve presidents, the preferences they voiced in the meeting, and even the vote outcome at the end. Now, this is probably not surprising for 2 reasons. On the one hand, there's a governance reason for this. So Reserve Bank presidents are accountable to their own board of directors, which is a regional board. So the directors are basically recruited from financial industry, from businesses, or the community in general. And the Reserve Bank presidents are accountable to these people. So their reappointment depends on their board of directors. So for that reason, they might already be interested in sort of understanding what's going on in the regional economy. There's also another reason, and that relates to the role the Reserve Bank presidents have at the FOMC. So basically, it's their job to bring intelligence about regional economic conditions to the table. And this is institutionalized in 2 ways. On the one hand, there's the so-called beige books. So 2 weeks before each meeting, there's a publication by the board where each Federal Reserve district basically talks about the economic conditions in the regional economy. And at the meeting itself, there's always a first sort of tour de table where everybody talks about the economy. So that's the economy go round. And again, the regional Reserve Bank presidents obviously, by definition, talk a lot about their regional economic conditions. So it is their role to bring regional economic conditions to the table. So that, therefore, it also shouldn't make it surprising that when their behavior in general is related to regional economic conditions. Now, how does voting right affect behavior, and how does this relate here? We are basically formulating two hypotheses in this paper. The first one is what we call a loss compensation hypothesis. And here the idea is that if you're losing the right to vote, you're less influential and you want to compensate for this loss. And what you could do, for example, is you want to be more vocal about your view because you want to convince the others, or maybe the financial markets, about the best thing to do in the next upcoming FOMC meeting. And so our hypothesis would be this makes you more responsive to regional economic conditions. The second hypothesis states the exact opposite. It's what we call the gain enhancement hypothesis. And here the idea would be, if you have the vote in the year where you have the right to vote, you're more involved because you understand that what you do matters more for the outcome, for the final decision. So you're more committed, you're more involved. You take this more seriously in that it's your role to actually collect regional economic conditions. And so you're more responsive to regional conditions in the years with the right to vote. So you see the hypothesis goes the exact opposite. And to foreshadow the results already, what we find empirically is a lot of support for the gain enhancement hypothesis and not much support for loss compensation. So how do we do this in this paper? Well, we're asking three questions. The first one is, what's the effect of voting right behavior, voting right rotation on what people say during the meeting and what speeches they give in between meetings? And basically, we find that speeches and interventions depend more on regional conditions in the years where they have a vote. Then we also have a nice external validity check here, in the sense that there is an external observer of these speeches. And so we can check, what do financial markets do? How do they react to those speeches? And maybe surprisingly, we find that markets react less to the speeches that are given by voters than to non-voters. And so the third question we ask is, how does this make any sense? So is this consistent with the observed difference in behavior? And we're going to be arguing yes, because the voters talk a lot more about the regional economy. And so it's harder to extract a signal about the US economy from speeches by voters. So this difference in market reaction is actually consistent with the difference in behavior. Let me go over the data. So the core data set, of course, is a data set of speeches. So we've downloaded the text of around 3,000 speeches between 94 and 2013. The reason is that we also want to look at the transcripts, which come out with a 5-year delay. So that's why our sample ends so early. We've taken them from various sources to make sure we cover as much as we can. Then already Juan in the earlier presentation gave a nice introduction how you generate sentiment or speech tone. That's pretty much the same thing that what we do here. So we have a dictionary, we calculate the share of negative words in overall words. We do this sentence by sentence where we adjust for unemployment, because unemployment is in this dictionary a negative word. And of course, it goes in the exact opposite. So if unemployment is increasing, the monetary policy implication is the exact opposite than in inflation is increasing. So we make sure we sort of adjust the dictionary in sentences that talk about unemployment. Then we also only want to cover monetary policy speeches. So these Reserve Bank presidents talk about many things. We have sort of a technique to hopefully identify monetary policy related speeches. And then we aggregate speeches to the FOMC frequency for every speaker in the rotation scheme. And we have around slightly below 1,000 speeches left and 1,700 president meeting observations in the sample. In addition to speeches, we also have the tone of the transcripts. So that allows us to check for the interventions they make during the FOMC meetings, where we calculate the number of words and again, the tone. we have the text of the beige book, which we separate into each Fed district. And so we can calculate the tone for each Fed district. And of course, we have regional economic data, in particular district level unemployment rates. Then the last type of data that we need to have, of course, is the voting status of the Federal Reserve Bank presidents. That's available on the website. Again, it's mechanical, so it's easy to calculate this. This slide just to show you that voting status is exogenous to economic conditions, not surprising. So there's no statistical significance in this sort of little regression that you see here. So let's look at what we find. So the first analysis is on the speeches they give in the intermeeting period. And basically, we are running an ordered probit regression here. You can only do probit, do they give speeches, yes or no, or you can run an OLS. Effectively, they give 0, 1, 2, 3, or 4 speeches in our sample. And we're trying to explain the number of speeches with a speaker fixed effect. So this is mu I here. I hope you can see the little hand. Because some speakers might talk more generally than others, and so we want to control for that. There's also a period fixed effect, because there might be some periods where there's more communication, maybe because there's a financial crisis or something like this. So we want to control for this as well. And then the third variable is the first one that's really of interest to us here. This is the absolute difference between the district level unemployment and US unemployment. And the existing literature basically tells us that this is something the speeches do respond to, and we would expect the larger this absolute gap is, the more the bank presidents actually talk. So we would expect the coefficient beta n to be larger than 0. Then we have a voters dummy in here, and we also have an interaction term of the unemployment gap with the voter dummy. And basically the gamma n parameter is the one that's really of interest for our hypothesis. So we would expect beta n to be positive. We would expect beta n plus gamma n to be positive, but the gamma itself could be positive or negative. So our loss compensation hypothesis would argue that gamma should be smaller than 0. So in the years when they have the right to vote, they should actually be less responsive to regional economic conditions. And the gain enhancement hypothesis predicts the exact opposite. In the years they have the right to vote, they should be more responsive. So gamma n should be larger than 0. And here's the first set of results. So the first column just shows you basically a replication of the results in the literature. So the number of speeches is responsive to the absolute unemployment gap. So this is fine, but now let's differentiate this across voting status. And then you can see here that the gamma coefficient is significantly positive. It's relatively weak here in this sample, but then you see that the overall effect for the voters is highly significant. And if you split this up into the pre-beige book release and the post-beige book release periods, which is the next columns here in this table, you see that these effects effectively come through in the first part of the sample, which is the period of time when it's still the job of those people to actually sort of assemble regional economic conditions and write them down in the beige book. So this is really where we find this effect, and that effect, given that gamma is positive, basically gives us support for the gain enhancement hypothesis. Now, the next set of regressions we run is on the tone of speeches. I'm not going to give you the equation here, just to say that now we expect the beta coefficient to be smaller than 1. So if unemployment is relatively high, we would expect speeches to become more negative. So this is the way we coded this. And therefore also the gamma coefficients basically would swap signs. So for gain enhancement, we would expect gamma to be smaller than 0. And again, this is effectively what we find. So the gamma coefficient is smaller than 0. And again, it is smaller than 0, in particular in the first part of the sample of the intermeeting period, which is the pre-beige book release. So again, support for the gain enhancement hypothesis. Then we do a lot of robustness tests. We do a couple of extensions. So we look at periods that follow a dissenting meeting or a surprising decision. And following dissent, we find more support for the gain enhancement hypothesis. following a surprise, we don't find much of a result here. The next step is we look at what do they actually say at the meeting. So far we talked about speech behavior before the meeting. Now let's look at deliberations during the meeting. Again, we run two types of tests. The first one just looks at word count, and we find no differences in the length of interventions. So this could be because the meeting just has a roughly fixed duration. It's very hard to increase the speaking time that you can get, possibly, we don't know. But we find interesting results for the tone, which again, it's easier to vary even if you have a fixed duration of the meeting. So here we find again that the gamma coefficient is significantly negative. And remember, for any regression related to tone, we expect a negative coefficient for the gain enhancement hypothesis. So again, that would be in favor of the gain enhancement here. And when do we find this? For the first intervention that they give during the meeting. And remember, the first intervention is the economy go around. This is when they actually talk about economic conditions, about the US, but also about the regional economic conditions. Then we move on to checking how do markets see this? How do they react to the speeches? So now we go back to the intermeeting speeches here. And we go to a daily data set here because we don't have the exact timestamp of all of those speeches. We explain the absolute daily change in treasury yields at different maturities. The reason we explain the absolute daily change is because we don't have a measure of the surprise component contained in the speech. We have the tone, but we don't know what markets would have expected. So all we're interested in here is how much does a speech actually move markets overall. And in our regression, we again control for president or speaker fixed effects because some of them might be seen as more influential than others. We have day of the week effects, and we have a voter dummy. And this is what you see here in panel A. So the voting dummy is estimated negative, weakly significant, but it's significant. And the size is actually relatively large. So the minus 0.006 actually means it's sort of a quarter smaller than the effect that the non-voters would have. So this suggests there's a vote discount, and it's big. And if we look at panel B, the vote discount effectively sort of comes in strongest again in the pre-beige book period, which is perfectly consistent with what we've seen before. So then the last question we ask here in this paper is, does this make sense to see this type of market reaction, the vote discount? And we think it does. Admittedly, however, initially we were surprised because we thought, a voter is a more influential committee member, so the market should actually listen more to what the voters say than to what the non-voters say. However, there might be something else at play here as well, and that could be a signal extraction problem. Okay, so what the market is interested in is basically the outcome of the FOMC meeting or the outlook for the US economy as a whole. They are not interested in a regional Fed district. They want nationwide information. Now, of course, the voters we learned actually talk a lot more about the regional economic conditions than the non-voters. And so it's much harder to actually extract information from the voter speeches. And we tried to test for this with the table here on this slide. So the first column basically repeats what you've seen before already. This has period fixed effects. And so basically here you see that the non-voters are not responsive to regional unemployment. Now, if we take out the period fixed effects, that means we include variation that is common to all the Federal Reserve districts over time, which is effectively the US economy, then we see that the non-voters are responsive to unemployment conditions. Okay, so the non-voters respond to the US economy, but not so much to the regional economy, whereas the voters are very responsive to the regional economy. And that implies there's sort of a stronger signal extraction problem for the market when they want to look at or understand the speeches by voters. So in that sense, we think the vote discount actually makes sense. And let me wrap up. I think I'm nearly out of time. So basically, we look at this paper, how voting right rotation affects behavior. And we're arguing that having or not having a voting right actually does affect behavior. Our evidence supports the gain enhancement hypothesis. It goes against the loss compensation hypothesis. And markets seem to care about this difference. And we argue they do so in the right way. But I'm curious to see what Michael has to say about this. But let me say one last word on this. We see this as a positive, not a normative analysis. So we don't have a structural model that allows us to test whether there's an overemphasis or an underemphasis on regional economic conditions, whether the outcome is optimal or suboptimal. We really have nothing to say on this. And with this, let me end here. Thank you.
Michael, thank you. That was exactly on time and super interesting. Perfect presentation. Thank you. So your discussant, as you just said, is Michael MacMahon from the University of Oxford. Michael, over to you.
Great. Thank you very much. And thanks for putting on a great conference. This discussion it's been a beautiful opportunity because Stephen and I, when we started working together on a PhD, actually started on things like voting type behaviors on committees, and then we drifted into the communication and tech side, and this combines both. So it's like, you know, it's like Michael Ehrmann wrote it for us in a way. It's so I have a bunch of questions, comments, things to clarify. I think I'm going to summarize by saying it's a super interesting paper. Most of what I say are little niggles, and there's just a few bits where if I was playing the role of referee too, you'd have to convince me a little bit more. Okay, so let me jump into that. I won't summarize. In fact, I'll essentially skip reading out most of the first 3 slides, which Michael explained very well. I mean, just to summarize my interpretation of it, it's sort of like about how much they're willing to engage these people. Like, you know, so if they have a vote, do they see that as, oh, that's my power, therefore I don't need to use the other things, that's lost compensation? Or is it that, you know, when they have the right to vote, they're like fully in, they're like, now I'm a fully paid up, committed member of this committee, I have responsibilities and I should take this very seriously. And obviously it's the gain enhancement that sort of dominates the results in the paper. You know, one of the bits that sort of runs through most of the paper, but you know, and Michael explained it, but I'm just going to touch on one bit of it here. You know, when looking at the effect of local conditions, which is an important driver of the differential behavior of these bank presidents, when looking at the number of speeches or the length of interventions, the sort of the local conditions variable is relative to the US average, and when looking at the absolute value, which is because they don't have a directional interpretation necessarily, and then on the tone where they do have directional, it's just the unemployment rate. Really minor quibble as to, you know, explaining to the reader a little bit more why you're doing that. I figured it out, but also why it's not the relative position of unemployment that matters, and whether or not your fixed effects would eat it all up if you did include it. So that would be useful. Again, Mike's explained this very well, so I won't linger on that. I'm gonna start my sort of big picture comments with the quote from Larry Meyer's book, A Term at the Fed, where he points, you know, the chairman's disproportionate influence on FOMC decisions, his efforts to build consensus around his policy recommendations before FOMC meeting, and the strong tendency for committee members to support the majority view, all were secrets of the temple that I learned at my first FOMC meeting. So this is a book from 2004. The sample is 94 to 2013 with the transcripts, and maybe up to 2018 for the speeches. So it sort of raises 3 questions. One that I think the reader, especially those not dedicating their lives to looking at the FOMC's behaviors, would like to know are things like, you know, exactly how important are FOMC presidential members, not just when they're voting or non-voting, but more in general. The time that you're looking at is a time of, I think, or as I understand, and you can almost see it in the data, quite a lot of change. So, you know, under Greenspan, it was a much more sort of dictatorial committee. Bernanke and then Yellen have brought more, of a sort of normal committee discussion involved, and whether that's important and needs to be thought about in terms of the effect of being a rotating member. And another one, which is just about the generality of the results to, say, other institutions, is how much of this is to do with just cycling of position. So as opposed to I'm always a voter or I'm always a non-voter, and whether or not you sort of endogenously, settle into different roles. So again, it's going to be hard to do that because you don't obviously have that variation, but some discussion would be nice. In terms of one little quibble on the sample, which I'll mention here, it wasn't fully clear to me whether when you, and this came up in what you presented, you said, you focus on the presidents in your sample. I wondered if you're also including, the governors, even though you're not analyzing their behavior, their behavior will be important for determining the time fixed effects. So them and even the staff interventions could be really important for determining what we might think of as the kind of normal response in a given meeting, and then looking at the variation around that. So that wasn't quite clear to me. I thought it was clear to me, but then what you said something in your presentation. So maybe if you can just clear that up. The second is the role of local conditions in this. And that's a kind of maintained hypothesis that the regional economic conditions drive their behavior. Now, I'll just lay my cards on the table. I'm fairly skeptical that they are or they should. And there is an existing literature which you refer to, but I'm not sure it's as conclusive as to say, yes, definitely the regional conditions are what matter. And even if they do, I think you should help the reader by explaining why you focus on unemployment. There are lots of elements of regional conditions, and inflation is another one that central bankers should care about. And you do, in some of the results, include those in one of the columns. And in at least for some of the results, so for example, the number of speeches, if you include inflation controls as well, at least the individual coefficients become insignificant again. So it'd be worth talking about that. The other bit I wanted to mention was this other quote from that Larry Myers book. It's actually the next paragraph on from the one I showed earlier. So was the FOMC meeting merely a ritual dance? No. And he basically goes on to say about how it's a sort of dynamic persuasion event where I'm trying to convince people of a narrative, and they, I listen to them and I change my view. Maybe not today, but I change my view for the next time. And it just struck me that, why would the conditions in Cleveland or Atlanta be useful to convince all the other members if I'm playing a persuasion game? So if I think about it from that point of view, I thought actually sticking to the national story, like you suggested the markets do, would be the way to possibly convince your colleagues. So in the work that Stephen and I have, I just took this directly from there. We have a topic where we capture from our LDA how much time they spend talking about, well, I'm calling it the beige book topic, but it's like regional conditions and district conditions. And I can look then at individual members. Now, this includes everybody, including the staff, with fixed effects in the last two columns for individual members, but time fixed effects throughout. You can see that this beige book topic is one that in the first part of the meeting, the part about economic conditions, presidents talk about way more. But actually, in the data, when they're a voter, they tend to talk, again, not with person fixed effects, they tend to talk a little bit less about the regional conditions and stick more to the national conditions, which I actually think goes in line with your gain enhancement idea. I think they're really bought into the aggregate picture. Whereas, actually, even including member fixed effects, when they're voting, they're just less likely to talk about this, particularly in the part of the meeting where they discuss what we call FOMC2, where they discuss the policy decision. So again, I actually think that's supportive of your idea, but it doesn't rely on them necessarily interacting with how much they react to local conditions. Just without any of that, the people who are voters seem to talk less about their region and more about the national. I'll skip the next bit in the interest of time. We also have a bunch of different measures of preferences, which I thought you might, usefully use in the paper. So there's Ellen Mead's descent in voice measure, which only exists for about half of the sample, but I applied it to that anyway. And you see that there, once you include member fixed effect, there's actually no difference its negative coefficient, but there's no difference that voters are any less likely to dissent in voice than non-voters. I also do it for a measure that we have for longer, which is a much bigger sample. It's a measure that Stephen and I sort of made out of the language, which is the sort of probabilistic measure of how likely they are. Unfortunately, it's the mirror. So this is the probability they don't dissent in voice. But you can see that there's no difference there for voters, at least significant difference. But what is interesting is the more members talk about this topic 28, which is the beige book topic, in that second part of the meeting, the more likely they are not to dissent. So in other words, in my reading of the data, the people who spend the sort of go roundabout strategy talking about local conditions, they're actually less likely to dissent. So again, I think it fits with your hypothesis. It's just, I'm not relying on the interaction with local conditions. So yeah. Okay. On the speech analysis, yeah, I think it's super interesting. Two things on this. One, it doesn't talk at all in this about the interaction with local conditions. I thought that was a little bit of a disjoint. It's a disjoint I liked, given my last comment, but for the reader, I think it would be useful to at least explain why it's not important, the local conditions, or maybe bring them in. I thought the results were interesting. I wanted to use this. My time is up, so I'm going to stop after this slide. But I have some work which actually doesn't look at the US, but looks at the ECB, actually. And in it, we develop a measure of, it's with colleagues at the Central Bank of Ireland. We develop two things in the paper. One is a measure of the futureness and the pastness of what's being discussed, and also a measure of the information deficit from the ECB. And what you see clearly in this top row, this is a measure of how similar your speech is to questions that came up in the press conference. The more you sort of address the questions, which we call the information deficit, the more markets move. So I think one thing that would be really nice in your paper is to look at, what content is in the speeches that seems to be generating the more information, to really dig into that. Now, some of this is, I'd love to see you discuss things like the endogeneity of what they talk about. Maybe when they're just non-voters, they feel freer to talk more, big picture, more forward-looking, and that creates the impact. Or, maybe they talk about a different horizon, or maybe they're just lazy and they only talk about the voting members want to play it safe, so they only talk about local. I think digging into that in sort of content would be really, really interesting. My time is up, so let me stop there. There were a few other things, but Mike, you and we speak enough that I can take them offline.
We do have time if you want to spend another couple of minutes.
I mean, we're really into the niggling, the niggly little, niggly little points about I'm not a fan of Loughran and MacDonald in this context. I use a bunch of examples here. Some of it focuses a lot on nouns, and I think it's great for the environment it looks at. But for monetary policy, and Mike and co-authors, they do some adjustment. But actually, there's still words that worry me, like the idea that's question is a negative, or persistent is a negative, is quite worrying. And transparency and stability, yeah, they are positives, but do we think they're positive about the state of the economy? I'm not so convinced. Michael and I have had this debate going back over our own papers. I actually think you do it for the right reasons, but in the paper you explain a different reason, which I won't go into. But I think your explanation in words was better, so I'll just skip that. And then the last one was just, measuring speech news is hard because of when the time it takes place, if it takes place after the markets close or towards the end of the day. And so I would love to see a bit of robustness on that. You do see when you have the time, the results look like the numbers get a bit smaller, maybe not relative to the absolute news, but whether or not you need to look at 2-day windows or something else might be something just as robustness. But like I say, I'm quibbling now, so I will definitely stop.
Michael MacMahon, that was a fantastic set of comments. Michael Ehrmann, would you like to spend a couple of minutes reflecting and reacting to what you just said?
With pleasure. Thank you so much, Michael. This was a fantastic discussion. It gives me a lot of food for thought. Some of the more minor issues, fixed effects, etc. I think they are we can deal with them very, very easily. Let me go over sort of the more meaty parts, right? Why unemployment? Why not inflation? We were puzzled by this as well, but effectively, I mean, this is what all the literature finds, right? And I mean, the only reason I can give, or the two hypotheses I have, is one is salience. So unemployment, other than a return on assets of the financial sector, is the only variable that actually gets measured at the Fed district level and gets published at the Fed district level. There's no regional Fed district inflation series, which I always found surprising. And actually, by the way, they now stopped publishing Fed district unemployment rates as well. So maybe, you know, that might be an interesting test to sort of see whether, if salience disappears, whether there's also less emphasis on that. But then, of course, unemployment is also something that is very dear to people, right? I mean, I think this is something that the Fed learned very vividly from the Fed listening events. So this is something people care about. So it is also part of the Fed's mandate. So, you know, why not? I think there's a couple of reasons. I still personally, I agree. I'm surprised inflation doesn't come up more strongly. That's sort of the only reasons I could come up with. And again, this is very consistent with what the literature find. Now, the other point is, you sort of showed the results for the beige book. I mean, what we're trying to argue is the beige book is the turning point in the cycle here, in the intermeeting cycle. And then there's another turning point, which is between the economy go around at the meeting and the policy go around at the meeting. And these two parts, I think, serve very different purposes. So the first part, the pre-beige book timing, I think, is really when the job is to go out to collect information, try to understand where are we heading. Same for the economy go around, right? This is really where the regional information is key to what they are supposed to do. Then the beige book, I mean, you sort of show that at the beige book already, there seems to be less emphasis on regional conditions. That's fine. I mean, this is what I would sort of see as the turning point. So I don't know whether this belongs to the pre-beige book or the post-beige book phase here, however. And I think this is also perfectly consistent that you don't find any differences in the preferences voiced in the second round of the meeting. Again, this is exactly what we're trying to argue in this paper. I think we are very doubtful about the earlier literature, which argues that regional economic conditions actually lead the regional Fed presidents to have different overall policy preferences and different votes. I'm very skeptical, and I agree, the literature is not conclusive on that. I would be very surprised. I mean, if they take their job seriously, they should talk about regional economic conditions in the first round of the meeting, and then they should put this aside and think about the US economy and voice their preferences according to the aggregate picture. And I think this is what we find, and this is what you find. So this is perfectly fine. Now, at some point, you need to explain to me how you actually managed to get a voter dummy into your regressions where you explain the dissent, because of course, dissenters are only the voters. So we don't have that analysis. I'm not sure how you managed to do this. And of course, I expected the comment on the dictionary. I know you're not a big fan of it. I always thought, you know, MacMahon and MacDonald, that's enough to make you like it. But we've, in the meantime, also applied another one, the Appel Grimaldi, and we actually also find results go through with this one. So hopefully you like that one better. Let me. So, well, on content of speeches, indeed, that is something we are looking into right now. So, thanks a lot.
Wonderful. Stephen Hansen, I think, mentioned that he has a question. So Stephen, would you like to ask?
Yeah, sure. Although I'm not sure Michael likes the Appel Blix Grimaldi dictionary either. Anyway. No, Michael, that was super interesting. So I'm happy I got to listen to that. I guess I just had a couple of big picture comments about whether we could interpret your results in certain ways. So I kind of viewed the results as falling in a kind of effort category and an attention category. And I don't know whether that's a useful framing, but the number of speeches you give seems like it might be akin to effort. And I guess one could argue that when you have a bigger stake in a decision, you put more effort into the decision. And some other results seem to be about what I pay attention to. Conditional on speaking, this is what I speak about. And I know you want to avoid normative, questions, but at least in the conclusion, I wondered whether you thought that distinction is useful, both for kind of organizing the empirics and thinking about the normative implications. Because ultimately, this is a design choice, right? To give people a voting right. And if giving people voting rights increases their effort, it seems like a good thing. But if it changes their attention, it's less clear that's a good thing, because we have no theory about kind of optimal attention versus local versus global signals. I guess the second question, if I have time, is on the speech results. So I know that there's this debate, which I don't follow too closely, but to what extent do central banks have private information about the economy above and beyond the market? And one of the things that I thought is difficult to think about in this literature is sometimes it may not be important. The signal the central bank gives you about economic conditions may not give me an update on real conditions, but it tells me how the central bank is thinking about economic conditions, which is important for the policy that they're going to take. But it seems like for your non-voting members, that's not true, right? Because in the end, what they think on economic conditions isn't going to feed directly into the policy rule, at least not so much as for voting members. So that seems more, at least potentially more kind of pure, this is just what an expert thinks about the economy. And that expert's view isn't necessarily going to create policy. And so I wondered whether you could speak a little bit to this information effect literature through looking at the differential market reaction between voting and non-voting members to get around this issue of whether it's real information or whether it's just, I need to know how the central bank thinks to predict policy.
David, can I come in?
Please go ahead.
Thanks a lot, Stephen. No, these are great questions. Let me start at the end. The information effect. Two sort of answers to that. Not sure they fully answer this, but the one thing I find interesting is that, again, let me reiterate: after the beige book has been released, our effects disappear. So this is, to me, sort of suggests that, once I've made it clear, this is my regional economic condition. I've done that part of the job. I can then move on to, what does it imply for the outcome, the overall outcome. And then indeed, it seems that the voters and the non-voters actually sort of affect markets in a similar way. So I think there is an information content about the US macroeconomic conditions and the outcome of the meeting, or maybe not about the US economic conditions, but how people perceive, how the FOMC members perceive that. It's just sort of overshadowed in the first part of the sample by sort of the regional economic conditions that seem to affect more of how they say what they say. Now, the first part of the question, effort versus attention, that's I think exactly what we're trying to bring in to this debate here. The earlier literature, which sort of argues that regional economic conditions affect voting preferences and actual votes, sort of is not benign, right? It would sort of imply that people have a bias. I'm given that I'm appointed in a certain Fed district, I want to push that Fed district's agenda relatively more than others. And this is where we're really skeptical. There's a lot of literature here right now as well, which sort of argues, these people even try to leak in order to preset the outcome by influencing markets. And I personally think this is not what is going on. It is really an effort channel that we find. So they understand, this is more important here. So they put more effort. They give more speeches, and they sort of focus on the role that is given to them, at least sort of for the first part of the cycle. And that actually sort of made me also realize I haven't answered to one of Michael's points. What is, if everyone was constantly giving a voting right? Of course, this is, as always, in sort of diff and diff type of analysis, you can never make a statement about the economy as a whole, or here about the committee as a whole. So this is, I think, very, very different, very, very difficult to answer. And in particular, there's a couple of proposals for changing FOMC membership that would go in this direction, right? That basically make everyone sort of give everyone a permanent vote and have smaller number of districts. And I think, effectively, that's as far as we can go with our econometric analysis. I think it's really hard to make any statements about sort of the non-rotation part of that. Thank you.
Okay, we're nearly out of time. Michael MacMahon, is there anything you'd like to, any closing thoughts you'd want to leave us with as well?
Yeah, well, I'll just respond to Stephen actually, and just say I do quite like the Blix Grimaldi one. It's so thumbs up on that. I just wanted to clarify one thing though. The beige book topic that I said we had was actually from the discussion in the meeting. So it's not using the beige books themselves. This is all within the meeting. It's just how often you talk about stuff that's from the beige books. And all I was trying to say is that actually it's exactly the case that yes, by rule, by design, the members who are presidents talk about local conditions. That's what they're there to do, like you said, in the first part of the go round. But once you get to the second part of the go round, where you talk about the policy decision, actually the ones who talk more about local conditions are less likely to dissent. And the dissent measures come because they're all from voice, right? So we've calculated one. Ellen Mead did it by, Chris Crow, actually, I remember who sat next to me at LSE for a while. He went through all of them looking for when people used words to say they dissent. Because that's the weirdness of the FOMC, right? People will sit there and go, this proposal is the worst decision ever. I can't believe you're going with it. And then vote for it because that's the sort of rules of the culture of the committee. But so that's how we have it. I'm happy to talk to you a bit more about that offline. And just one last thing for Stephen, I can actually see why a non-voting member would be interesting to listen to, even though their views now don't give you a sense of a policy today. They give you some forward-looking view, right? If it's the Chicago Fed president, they're not voting now, but within 12 months they are voting. So you're kind of trying to build up your picture of who's going to be setting the policy, further out. It'd be really interesting if you could tie that to, say, the maturity reaction to different speeches by different people, depending on how far they are from voting again, right? If I've just finished my term, maybe nobody cares about me because I've got 2 years until I'm, 2 years of barren time before I go back on for a year. I think that'd be super interesting to do. I'll stop.
Brilliant. That was a lovely ending and a wonderful start to our conference today. So let me thank all the speakers, two Michaels, Stephen and Juan, as well from the earlier session. I think it was a really, really enlightening session. And please join us again for the next session, which is at 1 o'clock. So you have half an hour to go and grab a sandwich and a coffee. See you in a while.
Welcome everybody to the 5th session of our conference. Today in this session we'll be talking about shadow banking and capital flows. Let me hand over to the presenter of the first paper, Quentin Vandeweyer. So Quentin, please, the floor is yours. You have 20 minutes.
Thank you, Francesca, and also thanks to the organizers in general, including David, for including the paper into the program. And so as you see on the slide, so today I'm going to present a paper called Central Banking with Shadow Banks. And this is a joint work with Adrien at the Sokol School of Economics and Matthieu Darracq Paries at the ECB. So because he's from the ECB, the traditional central bank disclaimer applies here. So as the name of the paper already indicates, our objective with it is going to be to provide a framework to try and understand how the existence of an ever-growing shadow banking sector is changing central bank practices. So the starting point for this presentation is the observation that the financial system of most developed economies is currently transitioning to become much less bank-based and at the same time much more market-based. So these developments have been a major source of concern for central banks because many of these market-based financial institutions or shadow banks are now engaged into the risky practice of liquidity transformation. And the issue is that, unlike banks, many of these institutions are not regulated by the central bank. And something that's probably even more important is that these institutions also don't have access to the central bank liquidity facility in case of financial stress. So many authors, and that includes Ben Bernanke himself, have actually argued that this element was one of the main explanations for both the severity of the 2008 financial crisis, but also one of the prime reasons why the Fed started to use all of these new unconventional monetary policy, balance sheets, monetary policy, QE, and this kind of thing. So this would include, for instance, the multiplication of facilities that would be lending directly to these shadow banking institutions, but also the subsequent large-scale asset purchase program, or QE, that were actually effectively also buying from the shadow banking sector. And that's something we show in our paper. So we can also extend a similar line of argument to what happened in March of last year, when the Fed, and at the same time also other central banks, did not hesitate to mobilize their full arsenal in order to contain the emerging COVID crisis. So yet, so far, what the academic literature has been doing is mainly to focus on the role of shadow banks in the regulatory arbitrage dimension, and not too much to think about the fact that these institutions are doing this liquidity transformation without a proper liquidity backup. So this is the purpose of this paper. We want to propose a very simple asset pricing model to try and understand how can central bank tackle liquidity crisis when you have an economy which has a large shadow banking sector, which is a very present question to look for. So to do so, we propose a model. Let me just check slides. Yeah, we propose a model which is an extension of the intermediary asset pricing model of Krishnamurti. And to that model, we basically had four main elements. The first element is that the banking sector is now heterogeneous and features both a traditional banking sector, but also a shadow banking sector. And the main difference between the two is that only traditional banks have access to a reserves account at the Fed and can access its emergency liquidity facility. So shadow banks don't have this option. Second, all banks are involved in liquidity transformation and therefore are facing liquidity risk when they are financing illiquid securities. Third, all banks can hedge against this liquidity risk by trading in an interbank money market, but only when collateral is available to do so. Fourth, the model features a central bank that decides both on its size and on the composition of its balance sheet. So before I'm diving into the model, I can also briefly preview the results of the paper. So the first result is that we find in our model that when bank capital is low, then a vicious cycle arises between declining asset prices and liquidity risk. And this creates a liquidity spiral that is very close to what Bruno Meyer and Pedersen have in their famous RFS paper. Second, we find that traditional monetary policy, so something like simple liquidity injections can solve the liquidity problem for banks, but does not always reach to shadow banks. And this can be a very big issue for financial stability. So in our model, this is going to happen typically when asset price volatility is high, so margins are high as well, and this makes the collateral constraint tight and money markets becomes impaired. Then we also find, sorry about that, I was here. Then we also find that the large-scale asset purchase program, or QE, can go beyond traditional monetary policies in avoiding the liquidity spiral. And the intuition here is that by removing illiquid assets from the shadow bank's balance sheets, the central bank is effectively reducing liquidity risk from the stochastic discount factor of the marginal investor in the market. And as a consequence, this pushes asset prices upwards. So in the interest of time, I'm going to skip the literature review, but I'm happy to come back to it if you want during the discussion. And so let me start and describe the model. So the model is an intermediary asset pricing model in continuous time. So we have a stochastic supply of Lucas trees with a process DST that is subject to a Brownian shock, and it pays a dividend A. We have three agents. We have banks, shadow banks, and households. And we also have one policy institution, which is the central bank. And as in Krishnamurti, bank equity issuance is capped, and this creates an incompleteness for aggregate risk. So in other words, banks cannot share risk with households as much as they would normally like to. Both types of banks also solve a liquidity management problem in the following sense. Every infinitesimal period, bank deposits are reshuffled between the different institutions so that some banks end up with a surplus and some other banks end up with a deficit. And then they trade in the collateralized money markets where surplus bank will tend to lend to the deficit bank optimally. And this issue arises, so an issue can arise when the deficit bank does not have enough collateral, because then margins can be too high. And this will be, when this is the case, then the deficit bank has to fire sell some of its securities at the fire sale cost lambda, and this can be quite costly for banks. And so one very important point is that a liquidity management problem is far worse for shadow banks than it is for traditional banks. And the reason is that only traditional banks have access to the central bank balance sheet, so shadow banks don't have this option, and they have to rely on well-functioning money markets. So the central bank has three monetary policy tools. The first is that it can inject reserves into the economy by lending to traditional banks. And this operation is useful because reserves are the ultimate means of settlement in the economy. So by holding reserves, banks are effectively hedging against liquidity risk. Second, the central bank can decide to lower its collateral requirements at the discount window and set it below what's required in money markets. And when it does so, it basically changes the proportion alpha to alpha plus phi. So you have now much more securities that are available as collateral in money markets, and money markets are functioning overall much better. And so you can think about this policy as adding securities to the pool of eligible collateral, or you can also think about just reducing haircuts at the discount window, and both would be equivalent here. So third, the central bank can directly purchase risky and illiquid securities with a portion nu T. And because the central bank does not necessarily have the skills to manage companies or to pick securities, we also assume that securities held by the central bank have a lower productivity alpha underbar. So last, and this is actually going to be playing a crucial role here, the central bank is never subject to liquidity risk. And the reason is that the liabilities of the central bank are directly money. So the central bank is always liquid and never face liquidity risk. Okay, so let me turn to the static results. So the first thing we do is to shut down the state variable dynamics by assuming that the government set up taxes, so to keep the share of wealth between the different sectors fixed. And when we look at a static equilibrium in which all agents maximize their H-engine utility functions with risk aversion gamma, intertemporal elasticity of substitution zeta, and time preference rho. And to build up intuition about the model, I'm going to start from a baseline case in which all frictions are turned off, and then I'm going to turn them on one by one. So in the frictionless benchmark, we get that, as expected, asset prices follows a standard golden growth equation, where securities prices are simply equal to the discounted cash flows. And that's what we see in the slides. When the intertemporal elasticity of substitution zeta is above 1, then prices are increasing the rate of cash flow growth mu and decreasing cash flow volatility sigma. So that's very standard. And from here, we had our first friction, the limited capacity of banks to issue equity to the household sector. And with this constraint, it is now the stochastic discount factor of the overall banking sector that prices all assets in the economy. And what we see is that the variable 1 over eta plus eta bar in red in the slides is making this adjustment by capturing the overall leverage of the banking sector. And so here comes our first result. So in the absence of money market frictions, when there is enough collateral in the economy so that there is no liquidity risk at all, then any change in any of the monetary policy decision variable are purely neutral. And this result, in a way, is just a restatement of the seminal neutrality result of Wallace 1981, but here now in the risk space. So when the central bank purchases some assets and there is no liquidity friction in the economy, then what the central bank is simply doing is to take the risk, risk on behalf of other agents. And if these agents are Ricardian, they simply react by adjusting their demand for securities to exactly offset the purchase by the central bank, and asset prices remain exactly the same. So next, I'm now allowing for the existence of a liquidity risk in the economy, with alpha now being below 1. And in this case, we have a new term phi squared that appears in the asset pricing equation. And that term reflects the fact that banks are now subject to some liquidity risk, and they cannot diversify away in money markets because of the collateral constraints is now binding. And we see that this liquidity risk depends again on the capitalization of the banking sector eta plus eta bar, the fire sale cost lambda, and the collateral availability alpha. So on this slide, I'm plotting the price of securities, liquidity risk, and net interest margin that banks are charging as a function of the total capitalization of the banking sector eta plus eta bar. So as we see, securities prices are more stable when there is no liquidity risk, and that's shown in the black line. And you compare that with a little liquidity risk as shown with the blue line. And you can then compare it, that's even more the case when compared to a larger quantity of liquidity risk that's now represented with the red line. So next, I'm now putting the central bank back into the picture, and I allow for banks to hold a positive quantity of reserves that is supplied by the central bank. And this quantity of reserves on the slide is N, and it's tracked in red. And it represents the first monetary policy tool that is available to central bank, like simply its capacity to inject more reserves into the economy. So first, we see that aggregate quantity of liquidity risk in the economy is a decreasing function of the quantity of reserves. So the more traditional banks are holding reserves, the less they're exposed to liquidity risk. But that's only going to be true up to a threshold M star, represented in blue here. These points represent the point at which traditional banks are now fully satiated with liquidity. Yet liquidity risk is not fully down to zero at this point because shadow banks cannot hold reserves directly. And so shadow banks still bear some liquidity risk in equilibrium whenever the collateral constraint is tight. So here I'm plotting the price of securities both with and without shadow banks as a function of the quantity of reserves in the economy. And the blue line corresponds to the case where we only have a traditional banking sector. And what we see is that the price of securities increases with the quantity of reserves as the liquidity risk in the economy decreases. And this pattern holds up to converging to its fundamental value, as we see in the black line on the slide. And at this point, adding more reserves doesn't help anymore because banks, again, are fully satiated. So in the economy with shadow banks now, that is represented with the red line, the picture is different. Securities prices are increasing in reserves, but it does not converge to the fundamental value because at this point, at some point, new reserves don't reach to the shadow banking sector. And so aggregate liquidity risk is now bounded below, as we see in the second panel in this graph. So next, I'm turning to the effect of QE. When the central bank purchases securities in this economy, it has a positive effect on asset prices because the liquidity risk, through the liquidity risk term in the stochastic discount factor of the intermediaries. And that's what we see on the slides. So because the central bank does not face liquidity risk, removing those assets from the market and holding them on its own balance sheet effectively reduces the total quantity of liquidity risk in the economy. And this pushes asset prices upwards. And at the same time, buying assets also reduces the productivity in the economy because, as I mentioned earlier, I assume that central banks may be less efficient in managing or allocating capital in the economy. And so this trade-off can be seen on this graph, looking at the red line. So securities prices are increasing in central bank securities portfolio new, as long as it reduces liquidity risk. But at some point, the loss in macroeconomic efficiency is going to kick in. And that's something we see on the slide here at the point where you have the kink on the first, on the panel on the left. And becomes basically this loss in macroeconomic efficiency becomes the dominant force. And then asset prices start to decline if the central bank keeps purchasing more. So that's probably not something that the central bank would like to do in this world. So what we do next in the paper is to look at the dynamic solution in which the movement in the two state variables are now endogenous. So the two state variables being the capitalization of the banking sector eta and the capitalization of the shadow banking sector eta upper bar. So in this case, what to do is to set up a collateral constraint that is pinning down alpha. And if you recall, alpha is now the portion of collateral that can actually be used in money markets at any point in time. And we set up this collateral constraint in order to satisfy a value at risk constraints whenever the banks go and land in the money markets during these infinitesimal intermediary steps. And that's what we see in the first line on this graph, on this slide. So with these constraints, what we see is that the haircut that is required on money market transaction now depends on the volatility of the collateral assets. So it makes it endogenous. And as illustrated on this line, this relationship creates a negative feedback between the functioning of money markets and aggregate volatility. So after a negative shock, the capitalization of the banking sector is reduced, and then the risk premia have to increase in equilibrium. And as a consequence, what happens is that the volatility of all securities in the economy starts to shoot up. And in turn, this has a consequence for money markets, because this increase in volatility actually is going to have twice an impact on asset prices in the economy. First, it will have a direct impact, and second, it will have an indirect impact through the functioning of money markets. So what happens is that because the volatility of asset prices is now larger in the economy, then what we see is that the margins becomes tighter. So there is much less collateral that's available in the economy. So money markets stops functioning well. And then this is reflected as a drop in asset prices, because the shadow banking sector takes into account the fact that, or internalizes the fact that they are actually taking liquidity risk whenever they hold these illiquid securities in equilibrium. And what happens is that because after this drop in the asset prices queue, then this triggers a second round in this loop, because in equilibrium, the banking sector, so shadow banks, traditional banks, end up being more exposed to a drop in asset prices. So their capitalization falls down even more, and then this starts a new loop in this picture. So in this graph, we compare an economy with endogenous margins in red to our benchmark economy with a liquidity risk in blue. And we see that the endogenous spiral creates an additional shoot up in endogenous volatility sigma, so exactly as I described previously. And that happens when bank becomes undercapitalized. So when you move on the left on this slide, that's the region in which banks are undercapitalized. So what happens is that when banks are very much capitalized, then they have lots of asset prices are more or less stable. But at some point when banks are not very much capitalized, then asset prices starts to fall. And what we can see is that this happens much quicker and much faster in an economy in which volatility is endogenous, because there is a lack of collateral, because collateral is now endogenous in this world. And so to conclude, so this basically concludes the main intuitions or ideas about our papers. And so the objective of the whole paper is to try to provide a simple framework to think about what we believe is a very important question, and that seems to be understudied as of now. So the question is, how can central banks adjust their operations to the existence of shadow banks that are living outside of their traditional reach? And one of the conclusions of this paper is that a market-based finance economy also needs a market-based type lender of last resort. And we think that's one of the primary way of interpreting the shift in central banking that we are currently observing towards more and more complexity and more and larger footprints of new monetary policies. And I'm now over time, and I'm looking forward to Roland's discussion.
Thank you, Quentin. This was really interesting. So let me now hand over to Roland Meeks from the IMF for his discussion. Roland, the floor is yours now.
All right. All right. Can you hear me?
Yeah.
Okay, good. So let me just check that I got the remote control. All right, there we go. I think I did it. All right, guys. So thank you very much for this invitation to speak about central banks and shadow banking. The standard disclaimer applies. This is not IMF official views, but if you're interested in official views, the IMF's Global Financial Stability report has got a lot of good stuff in there. October 2014, and even the most recent issue, April 2021, might be interesting for you all.
All right. So let me start by recommending this paper to everybody without reservation, especially if you're a macroeconomist, because the design of central bank liquidity facilities is really fundamental to financial stability and to understanding what central banks have been doing in the past year, while at the same time also receiving rather little attention. So as Quentin explained, the paper identifies a fundamental issue with the liquidity framework used by central banks and sets out the mechanics of a liquidity crunch caused by some intermediaries falling outside the safety net. I really enjoyed reading this paper. Although the technicalities are not necessarily mainstream knowledge amongst macroeconomists, the underlying economics of liquidity, the basic Holmstrom and Tirole framework of understanding liquidity, have been applied many times in familiar macroeconomic models. In fact, I would like to see more connections made in the paper to the macro literature. Thinking of Gertler and Kiyotaki's handbook paper here, it shares many of the same features. You know, there are banks which are subject to liquidity shocks. Some of them are in surplus, some of them are in deficit. There's an interbank market which is subject to liquidity constraints and various interventions. And I wrote a paper with Ben Nelson and Pierre Alessandri, which extended that framework to include shadow banks, which are interacting in a particular way that I'll comment on in a minute with traditional banks. Now, that said, macroeconomists can provide the same level of insights into the functioning of asset markets that you get from the framework used here. So, you know, it's really a case of complements and not substitutes. I also think the paper could benefit from forming a better link to the literature on monetary policy operations, right? When the paper talks about conventional monetary policy and unconventional monetary policy, it's the word operations is kind of hanging there. And, you know, if you're a macroeconomist and you come to this paper expecting to see, you know, inflation and whatnot and monetary, you know, it's a flex price model. You're not going to find those things. So we're really talking about the design of monetary policy operations. Now, I had lots of questions, but I have time for two in this discussion. So here's the first one. Okay, so the first question is, what if shadow banks provided economic services where, I mean, economic services different from those that banks provide? So as Quentin explained, the paper makes a distinction between intermediary types based on institutional considerations. Shadow banks are just the same as banks. They hold the same assets, they issue the same liabilities, but they can't access cash. Cash is the asset with a zero haircut always. It's always fully pledgeable. So the two sets of intermediaries, they can have transient exposures to each other, right? So I'm a deficit bank, I need liquidity. I go to the money markets and, you know, my reverse repo provider, it could be another bank, it could be a shadow bank, it doesn't really matter. In the model, the portfolios that the intermediaries choose don't include claims on each other, in other words. So these transient claims happen, but there's no kind of diversity in the assets or liabilities which are being issued by the different intermediaries that would mean that one of them wanted to, you know, share risk with the other, for example, by holding their liabilities. But in the real world, you know, shadow banks provide substantial funding for banks through the wholesale markets. Now, this is true of asset managers in particular, what the FSB calls the collective investment vehicles. So on the one hand, shadow banks fund banks. In the old school shadow banking, back in the day, banks were providing a lot of funding for shadow banks, right? So by holding asset-backed securities and providing, you know, liquidity enhancement to SIVs and all this kind of stuff, which just doesn't exist anymore. But the basic point is that banks and shadow banks, they are highly dependent on each other. Now, if that were to be introduced into the model, logically, it must mean that shadow banks are playing an economic function. So there's a paper by Correa and Savov, and also my paper with Nelson and Alessandri, where shadow banks do play an economic function. In fact, what they do is they manufacture collateral. They take the raw material of claims on these Lucas trees in this paper. They take the raw material of primary securities, and they improve the pledgeability of these assets, through bundling and destroying information in Correa and Savov's story, and implicitly in our story as well. So they expand the base of pledgeable assets in the economy, and they loosen economy-wide funding constraints. And so then the neat thing about that is that shadow banks, or the supply of liquidity in the economy, depends on the state of shadow banks' balance sheets. So it's a question for you guys whether having shadow banks play a role, which is more interesting than just, well, they can access the central bank, might change the intervention calculus that you've set out in some interesting way. All right, that's the first question. The second question is, how much liquidity insurance should the central bank offer? So as people know, a core principle in the design of central banks' operational frameworks is to avoid encouraging ex-ante risk-taking behavior. So a balance has to be struck between the provision of liquidity and the cost of creating incentives that encourage such risk-taking. And Ulrich Binseil's books, which I referenced earlier, would be a place to go to read the literature on that. In this paper, the central bank, as we saw, can use asset purchases to support the shadow banking system. I think Quentin explained really nicely that there's a cost-benefit analysis there, right? Somehow, when the central bank owns those Lucas trees, then, half the apples are kind of rotten. There's a real economic cost there, which kind of push towards a limit to what you want to do with QE, push towards a leaner central bank balance sheet. On the other hand, it was not clear to me what the trade-offs would be to extending access to the standing facilities to shadow banks. So remember, the standing facilities are those things which banks access on demand, like your deposit account or like your overdraft or line of credit. And in some sense, this is the obvious solution. And it's not completely ludicrous either, right? So the Fed's overnight reverse repo facility is heavily used by these collective investment vehicles, I guess mostly money market funds. And the overnight reverse repo is just a deposit facility at the central bank. That allows that portion of the shadow banking system to effectively self-insure, right? They can deposit their liquidity with the central bank and self-insure. So how much of that kind of less costly insurance should the central bank offer to shadow banks? It's clear to me from reading the paper that reducing liquidity risk is desirable in the model, but is there anything in there to make eliminating it undesirable? I didn't find discussion in the paper of the incentive effects, in other words, that could impact framework design. Maybe they're in some form, but I'd like it to be clearer. So the question is really, to what extent would the anticipation of central bank intervention reduce ex-ante liquidity risk for shadow banks, trading off the idea that on one hand, they might take more risk if they knew that they were going to be able to access liquidity when they wanted to. But of course, ex post, on the other hand, it's reducing their risk, and it's also supporting asset prices. So those are my two questions. Again, this is a really nice piece of work. It has many nice policy ideas. I didn't have time to praise all the cool things that the authors are doing here. So I really recommend everybody take a look for themselves. Thank you.
Thank you very much, Roland, for the nice discussion. Before we take some questions, Quentin, would you like to take some minutes to respond to Roland?
Yes, definitely. So thanks a lot, Roland. That's really the perfect discussion, because so I think the 2 points that you raised are definitely the most important ones. And that's also exactly what we are doing now, actually. So regarding the first point, so in the paper as it stands now, it's actually the case that shadow banks deposits and bank deposits are not substitute at all. So we're kind of using that as a reduced form way of saying that shadow banks are doing something different than traditional banks. But we don't take a stance on what this actually is, and this doesn't change anything substantial in the model. The only thing it changes is that the only thing it does in the model is to prevent the household from moving from traditional bank deposit to shadow bank deposits instantaneously. And if this would be the case, then the friction would be completely reduced, because what would happen is that household would always move completely to the traditional banking sector, because traditional banking sector is a superior technology in this case. So that's not so that's ruled out by this assumption. But I think we could go deeper and get into the understanding of what's actually going on there. It's also a very important open question here, because I don't know exactly. So I guess some part of the answer would be that they are doing some kind of regulatory arbitrage, but maybe shadow banks are actually adding something to the economy as well. And so I think that's up for debate. So that's for the first question. For the second question, that's exactly what we are doing right now. So and the answer is, there in the model as it stands now, there would actually be a reason for the central banks not to provide an infinite access to liquidity facilities to shadow banks. And the reason is that shadow banks or banks in this type of economy tend to take too much leverage in the first place. And so what by allowing for a little bit of liquidity risk, what the central bank does ex ante is to reduce the incentives of banks to do this, to actually leverage and to take risk on the fundamental side of risk. And so that's a mechanism that's there. And we are now looking at having that in the paper, and also looking at shadow banks that can be regulated and shadow banks that cannot be regulated. And the issue will really be in the shadow banks that cannot be regulated. That's where the questions. That's why you really ask the question: should you provide the liquidity backup to these banks that you don't regulate?
Thanks. So yes, there's a question that has come up, and I also have a question. Maybe I'll take my prerogative as the chair of the session to ask my question first, also because it relates a bit to the first question that Roland had about the role of shadow banks. So my sense is also that at the moment I've heard the term shadow banks used in two kind of very different ways. So in one sense, shadow banks are thought of as investment banks or asset managers, etc. I've more recently heard shadow banks referred to as these kind of new fintech lenders, etc. So these two sorts of shadow banks also have kind of very different roles in these markets, and then play a different economic role. And I wonder whether you could say something more about that. And I guess Roland's kind of comments were really applying more to the sort of shadow bank referred to as investment managers and so on.
Yeah, me as well, actually. So I think so you're right, there is an ambiguity here as to what's the definition of shadow banks, and because people have been using the same word to refer to different things. So I think conceptually, my definition of shadow bank is basically any financial institution that does some type of liquidity transformation without the backup of the central bank. So I also like the definition of Perry Merling, which is money market funding of capital markets. But for me, something that's very important to be qualified as a shadow bank, that is what I mean when I say shadow bank, is that you have some institution that is holding this asset on its balance sheet. So I wouldn't be thinking about a fintech originator that's just originating some mortgage-backed securities or some mortgages, and then repackaging them and then selling them to somebody in New York as a shadow bank. But something I came to learn recently is that actually many of these originators are actually keeping a lot of these securities on their own balance sheets. So in that sense, they would still be called shadow banks, in my definition.
So there's here also a question by David Aikman. Maybe you see it on screen, but I can read it for you. So David was wondering if you could say a few words about the effectiveness of the market maker of last resort policies in your framework.
I don't know if the question applies to the real life or if in my model. I guess I will answer in the real life because it's more interesting. So it seems to be that what happened in March was a very big test for central banks in general and their capacity to extend this line of credits or this liquidity facilities and all of these operations to back up all of the different corners of the economy. And what we've seen is that they stand up to the challenge and they actually manage to be quite effective. So it's always difficult to get an idea of what the counterfactual would have been without the intervention. But I think looking at what happened in 2008, they actually also did a lot. I think we can have an idea that probably things would have been very, very bad if the central banks did not act as a market maker of last resort, as we've seen.
If neither of you has any other comments, I don't know, Roland, if you want to.
So I really enjoyed reading this paper, and it's a learning curve for macroeconomists when they attempt to read finance papers. So just coming back on the second point, then. So the second point was really about these incentive effects and the logic of when does the central bank offer insurance and when does it when is it efficient for it to offer insurance, kind of bouncing off these two sort of considerations of ex-ante risk taking and wanting to avoid the costly fire sales ex post. And you mentioned regulatory arbitrage, and of course there's a deal, right? There's a deal which says, if I regulate you and I can oversee you, then I will also offer you this insurance. And in the real world, that regulation kind of pushes up on the cost of doing business, which really is what creates the shadow bank in the first place, right? So what makes it efficient for you to kind of unbundle these banking services is the fact that you can do it slightly cheaper because you haven't accepted that deal. And so I don't know, do you think that shadow banking is basically kind of pernicious for that reason? Or do you think that, if shadow banks are performing a useful economic function, so you said that they were providing different functions than shadow banks. So, in the model, I understand that, these deposits, banks and shadow banks, are somewhat differentiated, right? So they're not completely sort of substitutable, because otherwise liquidity could sort of slosh around freely between the two different institution types. But do you think that if they were providing a useful economic function to sort of counterbalance, that you could bring in some element of that trade-off, regulation for access trade-off?
Yeah, I think it's a very important question. I'm not sure I have a very good answer to that, but I think we better figure out. I think there is probably a little bit of that happening. It's a matter of quantifying. And so I think in economics, there is a rule that the less, or at least there should be a rule that the less regulated institution is the institution that grows. And that's something we've seen in the treasury markets with what happened in March of last year, that we put a lot of regulations on the banks and on the dealer banks as well nowadays. And so what happened is that many of the treasury holdings were actually done within the less regulated agent, which happens to be hedge funds. So hedge funds got into this business of trying to arbitrage the cash future basis. Mm-hmm. And then what happens is that these hedge funds don't have access to a repo facility, or at least they didn't at the time. And so whenever there is some issue with the repo market, which started to be the case in March, they unwind their position, they fire sale, and this pushes prices down. And the issue is that you can repeat this thing many times. So you can just put some regulation on some other institutions, and then you're going to just to kick the can down the road, and somebody else, some other agent, is going to do exactly the same thing later on. So I think we should start to, you're perfectly right, we should start to think about these dynamic effects happening at the same time when we design the regulatory framework for these types of institutional, for the overall global financial system.
Yes, so there's another question from David. David, you can unmute yourself and turn your video on.
Great, I hope you can hear me. Quentin, thank you very much for a really wonderful presentation, and Roland as well. I thought your comments were fantastic. I just wanted to clarify the question I put in the Q&A. So there's a speech that you may have seen by Andrew Hauser, who runs the markets area of the Bank of England, where he talks about the market operations that the Bank of England put in place in March 2020, which you kind of highlighted in your response. And he was kind of drawing a distinction between, I think he called it kind of buyer of last resort policies versus market maker of last resort policies. And the way he characterized things was, it was more that central banks were operating as the former, the buyer of last resort. So they were kind of stepping in huge quantities, taking a lot of liquidity risk off the table. But then these assets kind of now, for a long time, permanently, quote unquote, are residing on the central bank's balance sheets. And that's quite different from how ideally you might think a market maker of last resort scheme would work, where it's kind of two-way prices that are being offered. The scheme would kind of self-liquidate when prices return, when the kind of liquidity discount vanishes. So it would be a temporary scheme. And, there are questions about, should it be a budget principle sort of approach where, it is provided as the liquidity is provided at a penalty rates. I know you don't look at that in the paper, but I was wondering if you had any kind of views on that, on the effectiveness of that type of approach in the framework you offer.
Yeah, so that's a very good question. So if you really think about these interventions being about liquidity risk as I do now, it shouldn't be that difficult to get out. But that doesn't seem to be what's happening. So we know from 2008 that getting out took many years. We've seen taper tantrum basically. And so I don't know if I have much insight into that. My intuition is that maybe I'm completely wrong, but you probably have to do it gradually. That's the trick. Like the markets, especially with all the new regulations on so many of these institutions, the market cannot absorb a large chunk of this or reintroduction of these securities all at once. But I think there's probably room for doing that, and I also think this is probably a good idea to try to lower the balance sheet of the central bank footprint.
Thank you very much. Thanks.
Thank you.
Thank you, and thank you both Quentin and Roland for the great presentation and discussion. We will now pass on to the next paper of this session. So let me hand over to Andrej Sokol from the ECB, who will present his paper, How Does International Capital Flow? Andrej, the floor is yours.
Okay, fantastic. So thank you very much, Francesca and David and the other organizers for inviting us to present this paper, which is titled How Does International Capital Flow, and is joint work with Michael Kumhof from the Bank of England and Phurichai Rungcharoenkitkul from the BIS. And I should add that the standard disclaimer applies to all three of us. So let me start by showing you two pictures. So the one on the left is for the United States, and the one on the right is for France. So in blue here, I show the current account deficit. And as is well known, for the US, this has been mostly in deficit for the last few decades. Whereas for France, this has been mostly in balance over the same period. But if you remember your accounting, the current account deficit is basically represents the inverse of the change in the net foreign asset position. So behind a net foreign asset position, of course, there are gross foreign assets and gross foreign liabilities, the net of which represent then the current account. And that's the two other lines that are shown in these charts in red. And there's three things that I want you to keep in mind as I talk you through the paper about these lines. The first one is that typically, and that doesn't just hold for these two countries, it tends to hold for all countries, is that these gross inflows and outflows are at least an order of magnitude, if not more, larger than the net flows, i.e. the current account. The second feature is that they also tend to be much more volatile. And finally, the third feature is that the inflows and outflows tend to be highly correlated. So the paper is going to be essentially about these red lines, why they're interesting, why do they behave the way they do, and what can you learn for macroeconomic and financial stability purposes from putting them into an otherwise standard macro model. So in a nutshell, here is the outline of the paper. So I think we all agree that there is a renewed interest in gross capital flows and stocks, both in academia and in policy circles. So you just need to think of, in academia, of the work of, say, Helen Ray and others, Maury Opsfeld. You just need to think of the work that's been done at the IMF, at the BIS, etc. So we take that interest as given, and we try to then also justify it within our framework. Since the great financial crisis, there has also been a lot of empirical work based on much better and much more accessible data. So if you think of the work of Sebnem Kalemi-Özkan, Scott Davies and his co-authors, again Helen Ray and others. So on the empirical side, there's been a lot of progress. But our take on the literature on the theoretical side is that that one is actually lagging behind, and often macroeconomists still apply models that were designed to explain net flows, i.e. to explain the current account and the associated goods transactions, to issues that really call for a framework that speaks to gross flows. So that's what we try to do in our paper. So we try to weave in gross and net capital flows within a DSG framework, so within a standard open economy macro model. And we introduce this, this terminology whereby payment flows are sort of the financial flows that corresponds to goods trade, and that's the flows that you would normally have even in a standard model of the current account. But we are also interested in modeling financial flows, which are basically any kind of asset against asset transactions, which do constitute the vast majority of gross flows, and also account for the fact that these gross inflows and outflows are so much larger than net flows. And armed with this framework, we revisit several open economy macro policy debates that, in our view, have been sort of led to misleading policy conclusions due to the use of inappropriate modeling frameworks. So to make things a little bit more concrete, let me just give you perhaps the simplest example of the kind of flows that we have in mind. So this financial flow is about a household in Europe that just wants to transfer an existing deposit from Europe to the US for whatever reason. Maybe because they think that their European bank is no longer safe, or maybe because they just want to then conduct some transaction in the US. So how does this transaction start? So this transaction actually starts in Europe within the European banking system with the European household drawing down deposit from its account. So you can think about this as either them writing a check or as instructing their bank to wire a deposit to the US bank. So then this transfer is made, or the check is sent. There is a foreign currency conversion that in our model is assumed to, we assume that this happened on the US side, but it could also happen on the European side. It doesn't really matter. And then what that means is that there is now, so the US bank accepts this transfer and issues some deposits in dollars to the European bank. So this is, of course, a capital inflow from the US perspective, because this is an increase in the US's liabilities towards the rest of the world, because this increase in deposits shows on the liability side of the US banking sector. And of course, it does show up on the asset side of the European household. Okay, so this is the capital inflow part. But this transaction does not finish here. It can't finish here because the US bank has now accepted this means of payment, whether it was a check or a wire transfer, and this trade basically needs to be settled. And the way that works is that there needs to be some kind of interbank transfer between the US bank and the European bank to settle this trade. And in this case, what happens is that the US bank gets credited some interbank balances in euro on their asset side. And with that, this transaction is settled and is concluded. But what it has resulted into is, into a matching capital outflow from the US to Europe, because interbank transactions are also recorded in the balance of payment. So basically, the lesson from this kind of transaction, and this applies to any kind of transaction that involves purely financial assets, is that these transactions always have two legs. So wherever there is a gross capital inflow, there is also a gross capital outflow, whether this happens on the interbank market or whether this is just an exchange of assets against other assets. You can also think of, if you want to buy an international bond, you also have to pay for it. And then you have, an acquisition of foreign assets on the one hand, but you also have to give up some purchasing power to buy it. Okay, so the current account cannot change based on these two legs of the transaction alone. But what does change? Well, one thing that has changed is the US banking sector's balance sheet. So there's at least two things that have happened. First of all, the US bank has grossed up because it has issued some more deposits in domestic currency, and it has also increased its holding of interbank liquidity. Moreover, what it has done, the transaction has changed the currency composition of the US bank, because it has now more liabilities in its own currency, but it holds some more assets in foreign currency. And the paper basically is going to be about what banks do with this kind of imbalances on their balance sheets, and we are going to argue that precisely the behavior of banks and how they deal with these changes to their balance sheet determines, the macro responses and potentially what happens to the current account. But essentially, there is no necessary connection between what happens, between what happens to gross inflows and outflows and the current account. So with this in mind, these are the policy debates that our paper is going to try to speak to. So one is the first explanation put forward for the persistent current account deficit of the US, which was put forward by Bernanke, which essentially conjectured that a global saving glut was responsible for the persistent US current account deficit. Let me first summarize these, and then I will tell you what our take on these is. The second, live debate that we want to speak to is the notion that current account deficits, therefore net flows, are a sufficient statistic for financial vulnerability. And this is a notion that comes back recurrently whenever you talk about sudden stops, whether you talk about global imbalances and, similar debates. Then we will be speaking to at least one version of Triffin's dilemma, which is the notion that the US must sort of run a persistent current account deficit in order to provide the rest of the world with enough dollar liquidity. And finally, we will also speak to a literature that finds the high correlation between gross inflows and outflows either puzzling or as something that needs a framework that explains two different economic choices. Basically, one to save and one to invest. So our take on these debates is that, first of all, there is a distinction to be made between saving and financing, so between the current account and what happens to gross flows, and that you may well generate a current account deficit by generating a domestic credit glut in the US, and we're going to argue that this actually gives you more plausible behavior for financial variables than does a current account deficit literally generated by, say, foreigners wanting to save more by being more patient and therefore consuming less today. In terms of the current account and financial vulnerability, which is actually the only simulation that I'm going to be showing you today, we are going to argue that what really matters when there is a sudden stop is not the current account per se, neither before there is the actual sudden stop, nor in the adjustment following the shock. But what matters is the much larger stock of debt that stops being, rolled over by foreigners and therefore needs to be refinanced in a different way. And I'm not going to be saying very much about the other two policy debates, but essentially on Triffin's dilemma, our argument is going to be that there's, again, no necessary connection between running a current account deficit and being able to issue credit in dollars, either within the US or actually in the rest of the world. Whereas for the correlation between gross outflow and inflows, we're going to argue that this is mainly due to the way things are recorded in the balance of payments, and therefore at the aggregate level, this is mostly a matter of accounting. And you will also see it in our simulations, because our model incorporates these accounting rules and therefore has this feature by construction. So we think there is no puzzle there. So it is a quite complicated model. I'm going to just try to highlight the key features. So it is a two-country New Keynesian DSG model with banks and cross-border lending, of course. So banks are important for two reasons. The first reason is that banks, of course, issue loans and at the same time create the deposits, i.e. their liabilities. And therefore, having banks in the model is important to allow for this elasticity of the financial system, which has been shown to be important in accounting for the data, and which is also important in accounting for this volatility of these gross flows that I have shown you in the first picture. The other thing that's important about having banks in the model, of course, is that they're often involved in these settlement transactions that I showed you in the example at the beginning of the presentation. The last thing I want to say about banks is that bank deposits basically serves as the main means of exchange in the economy. So this is going to be a monetary model where deposits lower transaction costs, and therefore changes in the quantity of money in circulation have real effects. And of course, this is also a model where we have cross-border gross positions. We assume that all the banking in one currency is done within one country. So basically, banks in one country lend to both domestic households and foreign households, and also to foreign banks. Households, we assume, again, demand deposits in both currencies, and that the two currencies are imperfect substitutes. And you can think of this assumption that basically that you do your daily shopping in local currency, but you might want to buy financial assets in dollars. And finally, we do introduce these settlement transactions through the banking system, and therefore, and that's again needed in order to give a complete picture of these gross inflow and outflow transactions that always come in pairs. So this is just a picture of the model. I'm not going to repeat the things that I've already said, but I'm going to just highlight that in each country, there's two main agents, so that's banks and households. We always have a representative bank and a representative household. There is, of course, a central bank in each country that's just captured by a Taylor rule. And then these arrows just show all the gross transactions, that financial transactions that happen both within and across countries. So that's the domestic lending, the cross-border lending, and then the interbank lending. And of course, there is also the normal trade in goods. So just some salient features of the banking system. So functionally, we have just a fiction whereby the banking sector is split into three functions, which we call wholesale banks, retail deposit, and retail lending banks. But in essence, what wholesale banks do, they choose the size and composition of their assets. So basically, the amount of lending to domestic and foreign households, foreign banks, as well as their holding of interbank deposits, subject to a minimum capital adequacy ratio, so Basel regulation, and subject to restrictions to the amount of foreign exchange mismatch. And subject to restrictions on the exposures to foreign exchange risks that they can take on. And then we also have, a cost of maintaining exposures to foreign households, which economically captures the notion that banks in a country do not have direct access to lender of last resort facilities in the other countries, and therefore have to hold some liquidity in the other currency to self-insure against potential runs. But technically, it also serves to basically generate these interbank positions in the model. Whereas what retail banks do, they basically price deposits, and they also generate a spread on retail loans, which just reflects default risk as in a standard VGG model. This is the only thing that I'm going to talk with any degree of detail, which are these restrictions on foreign exchange mismatch on banks' balance sheets. So banks have two kinds of exposures to foreigners. They have exposures to foreign households and exposures to foreign banks. Exposures to foreign households are in domestic currency, because we assume that all the lending to foreigners is done in domestic currency, whereas exposures to foreign banks are in foreign currency, because that's the interbank positions that settle trades with foreign households. And depending on how you set this parameter phi, you get at least two polar cases, and then you can get a number of intermediate cases. So the first polar case is one where this phi is set to 1, and that's basically a situation where if you have a net exposure to foreign households, that is absorbed by the banks by taking on a another net exposure against foreign banks, and that's basically banks taking on foreign currency risk. And that reflects faithfully what happens instantaneously when there is a transaction such as that one that I've shown you at the beginning. But it's not a realistic assumption in the long run, because we know that banks don't like to have net exposures in foreign currency, which is why our baseline assumption is to set this parameter to 0, which basically says that whatever happens to net exposures to foreign households, you need to keep your net exposure to foreign banks to 0. Okay. So households have a number of optimality conditions to choose. In particular, they need to choose their holdings of both domestic and foreign currency deposits, which, as I said, are imperfect substitutes. And this is an important feature in our model, because this is what generates deviations from uncovered interest parity, and is one way through which changes to banks and agents' balance sheets end up having real effects. And the mechanism is the standard convenience yield one. So as soon as there is a change in the relative demand of or supply demand for or supply of domestic currency deposits versus foreign currency deposits, the relative convenience yields of one increases and or decreases, and that has direct implications for the exchange rate, because essentially if the relative convenience yield of a currency decreases, that means that that currency must pay a financial premium in order to be held, and therefore that's delivered by an expected appreciation. Okay, so that's the economic mechanism. The rest of the model is standard. It is a calibrated model, so I'll leave you to look at the slide for that. I am running out of time, but I just want to show you one simulation of the model, and that's going to be speaking about sudden stops. So there is this idea out there that current accounts are a sufficient statistic for financial vulnerability, and that they're also the main channel through which an adjustment occurs after there has been a sudden stop shock. Whereas what I'm going to show you is that if there is a sudden stop in our model, what happens is that you can't roll over an amount of debt that's much larger than any current account deficit you might ever incur. And what you need to do is you essentially need to change your balance sheet composition in order to meet that deleveraging imperative. So a sudden stop works like this, very briefly. So there's a shock. So there's a 10% decrease in foreign lending to home households. So this is just an exogenous shock. How does that propagate through the economy? So first of all, domestic households try to repay as much of that loan using the foreign currency that they hold. So they draw down their foreign currency deposits. But mainly what they need to do is they need to refinance these foreign currency loans with domestic currency ones. So they borrow more from domestic banks, then exchange that domestic currency for foreign currency, and then repay the rest of the loan. Okay, so that of course puts pressure on the exchange rate, so you get a real depreciation because you're just trying to sell domestic currency and buy foreign currency, and that then in turn does generate a current account surplus. But if you look what that surplus is in the first period when the shock hits, that's like less than a tenth of this large shock. And then if you look at the subsequent adjustment, again, this is really trifle compared to the size of the balance sheet adjustments that need to occur instantaneously in order to satisfy the balance sheet constraints of households. So I'm out of time, so I just leave you with my summary and looking forward to the discussion and to your questions. Thank you.
Thank you, Andrej. This is really interesting. I have some questions, but let me first hand over to Genevieve for her discussion, and then we can come back to this. Genevieve, the floor is yours. You have 10 minutes.
Thank you. I hope you can hear me clearly. My internet seems to be a bit variable today, so let's hope it stays stable. So first, thank you for asking me to discuss this paper. I thought it was a very interesting read and a very interesting contribution. So I was glad to have the opportunity. I should note that this discussion is my views and not the views of Danmarks National Bank. So to start off here. So I think you can summarize the contribution of this paper very clearly with it's breaking the equivalence between the cross-border savings flows, so as Andrej referred to as payment flows, so flows for goods, and financing flows, so those asset flows. And the prime motivation that I saw for this in the paper is this idea of excess elasticity. So something that Borio and Disnat have characterized. And it's the idea that the financial regime and monetary regime can drive an excess volatility of credit supply above and beyond the fluctuations in physical savings. And this is really important because if we think that this is excess, like this is more volatile than changes in physical flows, there's implications for the effect on the amplification effects. And I was particularly interested in how this is driving an additional potential for amplification beyond a standard financial accelerator effect. So that's going to be, I think, my main comment through this discussion, that I wanted a little bit more intuition as to how this new addition to the theoretical literature amplifies effects on consumption relative to the standard financial accelerator literature. So the way that the authors do this is they use a DSG model that has a bit of a twist. So this is building off of Michael Kumhof's work with Zoltan Jacob, where they have a DSG model that looks at household and bank optimization over gross financial and asset and liability positions rather than net positions. And this means that relative to a standard DSG model, even with a financial accelerator, there's much more separation between underlying physical flows and credit fluctuations. And so with this new framework, what the authors do is to re-examine a number of important recent questions in the open economy literature. And they do a lot in this paper, so I'm going to focus on just a couple here. So one, the global savings glut hypothesis. So this idea developed by Ben Bernanke was that the US current account deficit and low level of interest rates in early 2000s was primarily driven by an influx of foreign savings into the United States. And what the authors do here is they contrast a shock that's pretty directly taking that narrative from Bernanke, so simply that foreigners now want to save more, their time preference has changed, with a willingness to lend shock of the US financial sector. So this is just collateral value on US land is greater now. And what they find is that the willingness to lend shock drives a much larger increase in home currency loans. So a 12% of GDP increase relative to a 2% increase from the foreign discount factor shock. and that the spread in response to the home willingness to save shock falls. So this is important in terms of matching the data that we saw during this period, and suggests that the willingness to lend shock is potentially the more credible shock. I think even more interestingly, they find that the foreign asset price, the foreign discount factor shock predicts that there's going to be a boom in foreign asset prices. So their collateral increases, and thus actually predicts that credit increases in the foreign country and not in the US. So there's this lack of spillover to US credit provision, which I thought was quite interesting. But I, again, wanted a little bit more intuition as to how this transmission channel differs from a standard financial accelerator channel. So maybe it's a quantitative prediction, but perhaps if you could develop the shocks in a more standard model relative to this gross flows model, and show the quantitative or qualitative predictions difference to develop the intuition for the reader, I think that would help the contribution stand out even more. But yeah, that was very interesting. So, and then I'll briefly touch on the point on the Triffin's dilemma. So this dilemma simply states that an increase in the global reserve currency, so the US dollar, requires that the US run current account deficits. And by modeling, or by using their gross flows modeling framework, they show that this is actually not a dilemma. So it's because the current account reflects these physical flows, whereas the reserve currency creation is broken from that because of the gross flows nature of the framework. And so I thought this was quite interesting in terms of it helps explain the pre-1980 puzzle. But I was missing a little bit of an intuition as to what is sort of, how do I think about this in terms of the post-1980 data, where we see US current account deficits being actually quite large? Does this framework tell me that it's possible that an increase in US dollar reserves could drive an increase in deficits, but just doesn't necessarily do? And is there anything about the model that could help predict when this is going to happen or not? I think that would be a little bit interesting to know. And then lastly, on the point on sudden stops. So I think I'll touch on this very briefly because it was talked about in the talk, but the main point is that the current account adjustment, that increase, current account surplus, is an artifact of the adjustment in financial flows, not a driver. And what I wanted to know a little bit more is, relative to a standard model, what is the implication for other observables? So in particular, what's the implication for welfare? So I saw the results in your model, but what I wanted to understand is, if I look at a more standard financial accelerated model, is the drop in consumption lower, higher? Is there a greater amplification effect because of this break between physical flows and financial flows? Yeah, and lastly, so there you go. So that's sort of the three points that I wanted to highlight, and then I just have a couple of sort of more disparate questions. So I think going back to the point that I made before, I think it would be really interesting to potentially, if you could nest a more standard financial accelerator mechanism in your model, turn off the gross flows effect, and then turn it back on to compare the impact of adding this gross flow, to develop the intuition a little bit. And then I wanted to understand a little bit more what the willingness to lend shock was. Is it a relaxation of regulation on the US banking sector, or an introduction of less traditional like non-banks in the US? Some intuition there I think would be potentially interesting. I think the most sort of the thing that I wanted most out of this paper that I didn't get yet was, what was the implication for the design or calibration of macroprudential policy? So I think going back to the first point on this slide, there's a lot of potential to say maybe we need a tighter macroprudential policy in good times, because this gross flow framework predicts more volatile fluctuations in response to various shocks. But so I think that's maybe a question that you could shed some light on using the framework. And then a very minor point to end on. So the calibration seemed to be a mix of mostly US targets, but with some emerging market calibration. I thought that maybe you wanted to have two calibrations when you look at the global savings glut hypothesis, where you're taking the US view relative to the current account sudden stop experiments, where you're taking more of an emerging market is the home economy. So separating that, but that's a very minor point. So overall, very interesting, maybe a little bit more hand-holding of the reader to understand the contribution really clearly, but I thought it was a very interesting paper. Thank you.
Thank you very much, Genevieve, for the discussion. Andrej, do you want to respond? Take a couple of minutes to respond.
Yes, absolutely. Thanks a lot. So all very, very fair points. I'm just going to tell you what I could think of off the top of my head. So in terms of, what's new or whatever, what is there in addition to just a financial accelerator? So I can give you two very quick answers. So in terms of mechanics, I guess, I can tell you just that there's some additional frictions. In particular, there's a monetary friction that leads to, money to have real effects, which I'm not sure is there in BGG. So you just get some additional volatility through the effects of money demand and money supply on real variables. And the other thing, of course, that's there in our models is there's this imperfect substitutability between domestic and foreign currency deposits, and therefore deviations from UIP. And there, the degree of substitutability between the two currencies actually does directly translate into more or less volatile exchange rates, and that you can map into what then happens to the current account and consumption, etc. So I guess mechanically these are the additional frictions in the model, and these are these are the ones that then yield these additional, I would imagine, more elastic responses than if you just had a financial accelerator. Economically, I guess what our framework adds is precisely the fact that it does track all of these, gross positions, so all sides and all items on or relevant items on both households and banks' balance sheets. So you can really tell this story. If you just took a net flows framework, you could see the current account, but for instance, you couldn't see what is happening to net lending in one currency, in the other currency, and you can see that. And for instance, this point that we make, and unfortunately I couldn't talk about that today, but that if you generate a global savings glut by literally increasing foreigners' patience, you do not get the excess elasticity of the financial system that you do get if you instead generate it by inducing a domestic credit glut. It's something that you can only see if you separately track these positions. So in terms of economics transmission, I think the model is just richer. Then so I guess that also addresses your question about the global saving glut. And how's the transmission channel change? I guess it does. First of all, we have a richer story for how the transmission actually is, and then mechanically it does change due to these additional frictions. And then maybe just replying to your smaller questions. So I don't think the BGG friction per se and the small difference between our retail lending setup and the original BGG, I don't think that really matters so much. What really matters is really the imperfect substitutability that leads to UIP deviations, and the other thing that really matters is what you assume about how banks take on or do not take on these foreign currency mismatches. So really the two things that I try to highlight in the presentation are key to deliver all of the dynamics that are different from a standard net flow model. What is willingness to lend? So correctly pointed out, that might well be, just a decision of banks to, extend credit at more favorable terms. It could equally be a loosening in, LTV ratios by a regulator. Now, I'm not saying that that's what happened. That's what happened in the US in that period. But mechanically, that's also how you would simulate a shock to LTV. It is literally just a shock to the share of pledgeable assets, and it just captures any kind of notion that banks are willing to extend credit at more favorable terms. I totally agree with you that studying macroprudential policy, so endogenizing policy rules in this framework would be really interesting to do, and we would really like to do. I think we would really need to start with the central bank, and even the relationship of banks with the central banks. We're not there yet, but working on that. And on calibration, of course, I mean, there is a problem with with finding suitable data for everything that we want to calibrate, because it's a quite detailed banking sector model. And you're right, we mostly calibrated it on the US, but we do run some simulations where we specialize the other country to be an emerging market economy. And for example, by allowing one country, say the emerging market, to take on foreign exchange currency mismatches in their banking sector, whereas you don't allow that on the US side, that already mimics a salient feature of emerging markets versus the US. And of course, you can think of other things like, for instance, not having the US, not having US households wanting to hold both currencies, but only the dollar, and only foreigners wanting to hold dollars. So kind of have some form of dollar dominance in the international monetary systems. So that's all things that could be reasonably done. And you're right, could be more interesting for policy experiments. I think I should stop, right?
Yeah, thank you, Andrej. You have a couple of questions that are coming up, so let me pass you those. Quentin has a question, so maybe now he can unmute himself and turn the video on. He'll ask his question, and then we have a question from Golchinovskan.
Yeah, I'll try to be short. So the intuition I get from your paper is that you take into account the fact that many of the global dollar creation is done through FX swap markets, which is basically collateralized. So you need the flow going in the other direction as well. But I'm wondering if in your calibration, if you take into account the fact that you actually have some margins on these things that are going to drive a little bit of current account contemporaneous changes. And same thing with treasuries. I'm wondering if you take into account the fact that you also have treasuries are also a very good substitute for this FX swap creation by banks in providing dollar funding for other countries.
So we do not have treasuries, unfortunately, but basically, even if you issue treasuries, you would have to buy them with some other. You would still have to buy them with dollars as a foreigner. So it would still involve a gross flow in a sense. So basically, more issuance of treasuries would have to also mean some form of more issuance of liquidity in dollars for those to be purchased. And very quickly, we do have spreads on all relative to the risk-free rate on all of these balance sheet items. So maybe that does answer your question at some level, but we can also chat bilaterally and you can tell me exactly what you have in mind. We do not have FX swaps here because we don't have the central bank. So instead what we have is precisely these interbank liquidity friction that generates these interbank positions, precisely because an FX swap with a central bank would in a sense do the same job, because it would allow the banks to then access liquidity in dollars from their own central bank as if it was an access to a discount window, and we might not have to have the interbank market at the cost of having to model two central banks' balance sheets and how they interact across borders.
I was thinking about private swap, but we can speak about it later. Maybe I know you don't have much time.
Yeah, let's do that.
Thanks, Quentin. And let me relate to you the question by Gulcin Oskan, which came through the chat. So she asks if you have a quantitative measure of what proportion of international capital flows are originating from household borrowing lending behavior, because both the Asian crisis and the global financial crisis experiences suggest that external finance needs on the part of the corporate and financial and public sectors are what driven the capital flow dynamics and hence the sudden stops.
So so I don't know the capital flows data all that well at all. The only thing that I can think of based on my model, I have to just go back to my slides because I don't have them there anymore, is in our calibration, loans to foreign households, dollar loans to foreign households account for roughly 20% of US GDP, compared to loans to domestic households, which account for roughly 100% of GDP on banks' balance sheets. So that maybe gives some sense of magnitudes.
Thank you. So I had a couple of questions, but which I think relate a lot to what also Genevieve had asked about the policy implications, both for macro prudential policy and also monetary policy, in particular spillovers. But so I just wanted to take your views on that.
Well, I mean, it's really hard to tell without putting policy in it. Like I really think it would be super interesting to endogenize. You know, we could quite easily endogenize the capital, you know, the minimum capital adequacy ratio, which, however, you know, you would think that's a policy, that's a tool that's changed rather infrequently. But of course, we could also, you know, try to control these LTV ratios. So instead of having this, you know, willingness to lend as a parameter subject to a shock, we could have something like a rule for that, and then of course a shock on top of that, and start looking at, you know, crude measures of welfare. I think the model is too big to do, you know, like optimal policy, start doing, you know, fancy approximations to the utility functions. But we could just say compare simple rules for these things, and look at, you know, the consumption and GDP implication of them, and it would be really nice to do, and we will try to do it.
Thank you, Andrej.
And the same for monetary policy, really, actually, because even monetary policy, I mean, monetary policy in this framework doesn't really contribute to, you know, this excessive elasticity, because basically it induces credit changes that are in line with the changes in GDP that it generates. But for instance, if we started to look into QE, and when you start playing around with banks' balance sheets with that, it might change again. So it has to be still done.
Wonderful. Thank you very much. And we're spot on time. So let me thank you all for, you know, the wonderful presentations and discussions. And I'll also remind the people that are listening in that our next session on climate risk and the financial system will start at 2:45, so in 15 minutes. Thank you, everybody. Bye.
Hello and welcome back. Welcome to actually the final session of our annual conference. And we're going to devote this session to climate change and the risks created from climate change for the macroeconomy and the financial system. We have, again, two fantastic presentations and two fantastic discussants as well lined up. But without further ado, let me introduce our first speaker, Francesca De Luiso, from the Mercator Research Institute on Global Commons and Climate Change. Francesca, you have 20 minutes. The floor is yours.
Thank you, and thanks for having the paper in the program. This is a joint work with Professor Anni Chiarico from Tor Vergata University and Professor Calculla Meeks from MCC Berlin. This paper follows closely a recent debate about the role that central banks should or could play against climate change, and also on the role that climate change and climate change policy can have on central banks' mandates. There are concerns about the fact that disorderly climate policy could trigger asset devaluation in carbon-sensitive sectors. These, of course, raise concerns about financial instability, but not only, because, as we saw during the global financial crisis, financial instability could easily translate into macroeconomic instability. That's why concern both on macro and financial stability call for the attention of central bank and supervisors all around the world. And I would say that new research questions are on the table, for example, about the possibility of implementing new green instruments to deal with these new systemic risks. So far, at least for what concerns the new Keynesian DSG literature, modeling attempt to answer this question have been quite limited. There are contributions looking at the relationship between different climate policy and monetary policy, as well as paper looking at the performance of green macroprudential regulation in front of standard sources of shocks. And finally, there is a contribution assessing the impact of a green QE, green quantitative easing, intended as an instrument to foster the transition. This paper follows this trend of literature and is mainly divided into two parts. In the first part, we have climate policy shocks, and we explicitly analyze the role of climate policy, studying if climate policy could be a source of macro-financial instability, and also which are the implications for the monetary policy conduct. In the second part of the paper, if you want, we generalize a bit our research question and we look explicitly on a financial shock. So we introduce a standard devaluation of fossil assets. Why is this a generalization of the previous question? Because, as you know, the definition of transition risk encompasses several dimensions. For example, could be a technological breakthrough, a change in market sentiment, as well as ambitious climate policy that can drive the economy toward a risky pattern. That's why we do not formalize the origin of the instability, but we directly introduce a financial shock. And here the question becomes, could be green QE and green macroprudential regulation in the forms of brown penalizing or green supporting capital requirement could be effective response to stabilize the economy in a wake of a financial shock? And if so, are they in line with the price stability mandate? We rely on a new Keynesian DSG model modified to include energy sector, climate policy, and multiple financial assets. We have sticky prices, investment adjustment costs, and consumption habits. And we model financial friction as in Gertler-Karadi 2011. We calibrate the model on the euro area. Very briefly on the model structure, we have households that derive utility from consumption and supply labor to final good producing firms. Then we have energy sector, differentiated energy sector, a low carbon energy sector, and a fossil energy sector. This last sector produces energy by implying physical capital as well as a natural fossil resource. And polluting emissions in this model are a byproduct of this fossil natural resource. At the bottom level of this economy, we have capital good producing firms supply physical capital to low carbon energy producer, fossil energy producer, and firms in the final sector. Then we have banks receiving deposits from households and providing loans to the three sectors of the economy. We also have a public authority in charge of setting climate policy via carbon tax, conventional monetary policy via Taylor rule, green quantitative easing, and green macroprudential regulation. At the core of the model, as I said, we have financial friction. So we assume that firms in each sector of this economy can buy capital to be used in production by issuing claims, and the price of each unit of capital is equal in this model to the price of each claim. Just to give you an idea about the financial intermediaries balance sheet that we have in the model, on the left side we have the asset coming from the production, low carbon and fossil energy sector. On the right side we have liability, so net worth and then deposit. We slightly modified the standard agency problem at the core of the Gertler-Karadi model by assuming that the financial friction are not symmetric across assets. More precisely, we assume that the assets coming from the production sector are less risky, reflecting a measured diversification of this sector, while the assets of the energy sector are riskier, and in particular the green asset, the low carbon asset, are the riskiest one in our model. So going to the results, we modeled two mitigation scenarios, an orderly and a disorderly transition, and we find that if the government does its job in a proper way, introducing a gradually increasing carbon price, then transition costs in terms of output losses, output volatility, inflation volatility, and average net worth are not huge, are quite limited. Vice versa, if we introduce what we call a disorderly climate policy, so a sudden increase in the carbon tax, then we observe substantially higher output losses, and we also see that some effect on financial markets can arise. Overall, we find low impact on price stability. Consider that we are calibrating the model on the euro area. We also run the simulation under different monetary policy regimes, and we observe that a pure inflation targeting, or overall monetary policy targeting inflation in a stronger way, is able to limit output losses and at the same time reducing pressure on the financial market. We adopt a target-based approach, so we assume that over 10 years there is an emission reduction by 35%, and this is in line with the European reduction target for the period 2020-2030. Our mitigation scenarios differ mainly in terms of timing of implementation of the climate policy. In the baseline, as I anticipated, we have a gradually increasing carbon tax, while in the scenario that we call Turkey, we have an abrupt increase in the carbon pricing. As you probably can see, the dynamics are quite different. Let's start with the blue line, our baseline. Here, what happened is that following the introduction of the carbon price, there is a decrease in the demand of fossil energy that clearly becomes more expensive. So we have a decrease in fossil investment and an increase in low carbon investment because, of course, some substitution effects are ongoing in the energy market. Unfortunately, these effects are not sufficient to overcome the negative effect on the fossil sector. So we observe a decline in energy and also, I would say, huge increase in the energy price. On the other side of the economy, for the production sector, we observe an increase in investment and labor, and of course, an increase in production. Why this? Mostly because in this case, agents are able to fully internalize the mitigation plans, and they find optimal to increase production in the initial stage of the mitigation plans when the carbon price, if you want, is still relatively low, and then decrease progressively the production along the mitigation pattern. Vice versa, under the cold Turkey scenario, the story is different because in this case, the tax is implemented suddenly and is permanent. We observe that output decrease on impact, as well as investment in the final goods sector. We also observed that at the end of the period, the level of output is lower, as well as the level of consumption. And I would say that we lose something also in terms of decarbonization of the economy and structural change, because overall the level of fossil investment is higher and the level of low carbon investment is lower. Different story also on the financial side. Under the baseline, we have a gradual decrease of fossil asset value and an increase and then a decrease of bank capital. Vice versa, under the cold target, we have the standard financial mechanism accelerator that we have in this model, in the Gertler-Karadi model. So sudden devaluation of fossil assets, followed by a fall in network, rise of credit cost, and overall a credit crunch in the economy. The effect on inflation are mild under both these scenarios. But let's go to the second part of the paper. Here, as I said, we rely on a financial shock. To be more precise, we introduce this shock as a capital quality shock. And we observed that in response to this shock, a green QE could be used to stabilize the economy, could be effective, even if the results are not so different from that we observe under a neutral program. I will also add that understanding how financial markets are pricing climate risk is pivotal to understand the effectiveness of this program. And we find that the green QE is compatible with price stability mandate because overall the price volatility in the economy is reduced. Here in blue, we have the no policy scenario, so no quantitative easing. In red, the green QE. We assume that here the central banks can buy just assets from the low carbon sector, while under the neutral quantitative easing, black line, the central banks can buy assets from all the three sectors in the economy. The blue line is the standard mechanism that you have in front of a capital quality shock. So we have an exogenous and endogenous devaluation in the value of fossil assets. Fossil capital goes down, as well as the value of fossil capital in the production sector. We have a fall in output and a fall in the bank network and a rise in the spread. Under the quantitative easing, also here we have a pretty standard dynamic, right? Because we see that quantitative easing programs are able to stabilize output and consumption, and of course are able to stabilize the net worth. In this scenario, also the spread goes down and the banking sector is more capitalized. Let me underline that the green QE seems to perform a little better here. So in theory, in an economy without portfolio friction, and we don't model portfolio friction, banks can freely reallocate assets among sectors. So in some sense, they sterilize the fact that central bank is buying green assets. So the difference here coming from the fact that, as I said before, the green assets are the riskiest one. This means that by targeting these assets, central bank is absorbing more risk from the balance sheet of the banks. That's the reason they drive in this context the result. But as I told you, the difference are not substantial. You can say that we have a stabilization of output and inflation under the green QE. But I would like to drive your attention on the kind of sensitivity exercise that we run here. So in the last three lines, what we do is basically increasing the riskiness of fossil assets and see what happens in that case. We see that the stabilizing properties of the green QE are reduced because you can see this by looking at output standard deviation and inflation volatility. But overall, you also see that the effect of the same shock is reduced. This means that if financial markets start pricing climate risk, then we reduce the exposure. They reduce the exposure ex ante, and the impact of this fossil asset devaluation is lower. That's why we need to understand if and to what extent they are pricing climate risk. Now, our last experiment based on the macroprudential regulation. Here, we rely on the Basel II and III framework, assuming that the capital adequacy ratio should be no lower than 8%, but we remove the neutrality assumption. So what we basically assume is that this capital requirement can be relaxed for low carbon assets, and I will call this green supporting capital requirement, or we assume that the constraint could be increased, could become more stringent for fossil assets, calling this Brown penalizing capital requirement. We find that both the schemes significantly reduce the severity of a financial shock, but prolong the recovery phase. Overall, we also find that Brown penalizing capital requirements outperform green supporting schemes because they better mitigate second round amplification effect of the shock, and at the same time induce a greater portfolio reallocation toward production and green assets. Both these schemes reduce inflation volatility, and in this sense, they are compliant with the price, compatible with the price stability mandate. I'm not going to comment on the blue line because it's the same experiment as before, but I would like to comment on the red line, our Brown penalizing capital requirement. You can see that under this macroprudential policy, the fall in output is strongly reduced, even if the recovery here starts later compared to the other two regimes. And you can observe, compared to the green supporting capital requirement, that in this case we have a measured reallocation, toward low carbon and production assets. Why this? First of all, because we are targeting directly the sector affected by the shock, and we are wiping out the financial accelerator effect. You can also see that the macroprudential regulation pinned down the market capital adequacy ratio, so here is higher, and this prevents the fall in bank net worth. There is no possibility under these schemes to getting rid of the evaluated asset and also invest, issuing deposit, investing in high excess return assets. Overall, the level of asset in the bank portfolio is greater, and this explains why we observe this portfolio reallocation. So there is room for banks to increase the share of low carbon and production assets, something that is not there for the green supporting capital requirement. Under these schemes, we can see that capital adequacy ratio is lower, and so in part we are not able to completely shut down the financial accelerator effect. Here, just to provide you with some metrics, in red the baseline calibration, you can verify by yourself that Brown penalizing capital requirement, at least in the context of this model, performs better than the green supporting capital requirement. The result of welfare is totally driven by the reduced volatility that we observe under Brown penalizing capital requirement. Now, really some final remarks from my side. Regarding climate policy, I will say that giving the market the time to adapt to the mitigation plan is crucial to shape transition costs. And green QE could be a cyclical tool, but it's not significantly different from neutral QE. The rationale for implementing this instrument could be that of reducing ex ante the exposure to our fossil assets. But then my question for you will be, what about green bubble? Are we created then feeding a new kind of bubble? I think more research is needed on this side. On the agenda, we have also to implement a more flexible type of financial regulation, because here we rely on a rigid capital requirement. I'm aware that, for example, introducing counter-cyclical buffer can help in mitigate this side effect that we find regarding the recovery. Final message is that we need a taxonomy to understand what is green and what is brown before concretely talk and think about the effectiveness of this new green instrument. And that's it from my side. Thank you so much, and I'm happy to answer questions and receive comments.
Francesca, thank you. You timed that to perfection, and that was super clear. Okay, we've got a fantastic discussant for you. So Rick van der Ploeg from the University of Oxford. Actually, I can't think of a better person to discuss this paper at all. So Rick, the floor is yours. You have 10 minutes. You're on mute. If you just unmute yourself, there's a little button.
Can you hear me now?
Perfect.
Yeah, so this is a very timely paper on an important policy topic. Central bankers all throughout the world following the footsteps of Mark Carney, also in the ECB. We have Frank Elderson has been appointed, and of course, Madame Lagarde herself. They all stress the importance of looking at climate for central bankers and financial supervisors, because they're worried about the systemic risk it poses to the financial system. So it's an important topic. So the paper is somewhere halfway between macroeconomics, where there's not just unemployment, but there are also financial frictions on the one hand, and then looking at what climate policy does in those things, and looking at some green financial instruments. The paper is a modern new Keynesian macro model used by many central bankers. It's got it's got pricing based a la Rothenberg with adjustment costs for prices. It's got habits in consumption, and the novelty is that it's got three sectors of the economy: fossil fuel production and retail, so that it can look at climate questions. And there are financial frictions. It's based on the Gudler-Karadi model, where you have a commercial banking sector, and then you model the probability of default. So the two main market failures, which you should really remember right up front, is one is a global warming externality, which are not being priced in, and secondly, the financial frictions, which will then lead to excessive borrowing and a risk of defaults. So typically, I would encourage the paper to say about two market failures. So we need two policy instruments. So obviously the optimal policy instruments would be to have a carbon price to cope with the global warming externality. And for the financial frictions, you might have other policies to deal with that. And these are typically capital market requirements. So, but the paper doesn't really take that approach. It basically looks at various ad hoc policy responses, so like green quantitative easing and things like that. But it's not clear how it addresses those two market failures. So I would recommend the authors to go back to that. And the idea is then that that you come up with policy proposals for the national governments, for central banks or financial supervisors, and perhaps even for the ETS authorities. These are the authorities which issue permits. So what does the model find? Very quickly, it's a Euro model. It compares orderly mitigation with disorderly mitigation. I think it's a little bit claiming too much, because it's basically as a gradual decarbonization and a cold turkey decarbonization, if you want. But it doesn't really talk about risk, statistical risks, which is really what you need. So this kind of transition risk is inherently to do with uncertainty about future policy changes, and it's to do with uncertainty about future changes in the cost of, say, solar power panels. But that's not what the paper does. But it does look at other things, as you've seen. So, but what it finds is, given the framework, that provided that carbon prices rise over time, so I hope, provided that they ensure that the global warming externalities are internalized, so that the Paris targets are met, the transaction costs are modest. And that green quantitative easing can stimulate the economy without causing inflation when there are bad financial shocks to the oil sector. And then also when you have differential capital requirements to green balance sheets of commercial banks, that can weaken a crisis, but the recovery takes longer. So that's more or less the stuff, and it's been well kind of presented by Francesca. So it's a very important paper. But here are some suggestions for improvement. So first, in contrast to most macro models, the model is not really calibrated in any stochastic sense of the world. So I would like it to be calibrated to the variances as well. So anybody who uses Dynair or uses these, say, Wouter-Smets models or these kind of new Keynesian models would not just calibrate the first moment, would also calibrate the second moments. And then secondly, as I've already said, the carbon pricing policies are kind of fairly ad hoc. Why don't you say there is a target for cumulative emissions reduction, and from that you deduce what is the carbon price necessary to get that emissions reduction? So Europe has targets for emissions reductions, then deduce what kind of hoteling prices you need for carbon prices or for the permit prices to ensure those emission reductions. That's the way to do it, and rather than an ad hoc policy. Then I think you probably also need to allow for uncertainty, not only about the economy, but about the huge uncertainties we have about the climate system. So you want to have uncertainty about the temperature sensitivity. You want uncertainty about the impacts of global warming on damages, so on say total factor productivity, and then how those affect the optimal carbon price. So I've done recent work coming out by myself about Christian Golly as well. And then particularly you want to distinguish between these physical risks, like what's the effect of hurricanes, tornadoes on the economy and insurance companies. But you also want, and transition risk on the other end. And the transition risk is this uncertainty about what will happen in 5, 6, 7 years' time. So before Biden was elected, there was a huge amount of political uncertainty. Are we going to get coal with Trump, or are we going to get a greener policy with Biden? As soon as that uncertainty is resolved, you will get huge adjustments in asset markets. That's not the type of uncertainty discussed in the paper, but the paper lends itself very easily to discuss those issues. So I'm a fan of the paper, but I would do a few more of those exercises. So you might want to estimate some policy reaction function for the Taylor rule and also for capital requirements and use those as benchmarks. So I think one would want to look at the welfare aspects of the different policies. The gains or losses, and to see, what's actually best to deal with these two externalities, these two market failures in your model. So that's what I would suggest you do. So it's not clear. One of the things I might like to say, you can either penalize brown firms if there is transition risk, which I think should be modeled in a different way, or you can subsidize or make it easier for green firms, relax capital requirements for green firms. Well, you have to be very careful. You don't want to relax the capital requirements for green firms, because then you make the whole economy riskier. It's actually a bad thing to do, I think. And I think you can show that in the models. So the students I've seen who've done that. But if you penalize brown firms by tightening their capital requirements, that makes sense, because then you're attacking the market failure. So there is an asymmetry between this penalizing brown firms and helping green firms. You may want to explain why default never occurs in the model. It's a kind of interesting. And I think the policy simulations, what I'm trying to say is that you would want to do them slightly different. Well, then there's a lot of empirical work, and I'll be quick on this. So the main thing is that empirical work, particularly the papers by Bolton and Kaspicic, but also other stuff, show that the markets are increasingly pricing in carbon risk. They didn't, but now they are. Since the last few years, they're pricing in carbon risk. So if you look at these look at the left side, then you see these are the cumulative return premium over and above the ones suggested by the normal pharma French factors. So these suggest that over time, since about 2015 in particular, you see these big, you see more risk premium coming in. So that means that investors say, look, I'm happy to hold Shell or I'm happy to hold BP, but you must give us a much higher return to compensate us for the risk that you will go belly up. But we don't see those risk premium in those models. Again, you need the stochastics for it, but that's really the type of thing central bankers are thinking about. The right panels are the same for slightly different estimates, but the story is basically that. And also when you look in the banking sector, this evidence by this paper, the Liss et al., but others as well, that commercial banks, they judge carbon intensive firms as dodgy. They say, well, we will lend you money, but you're going to pay a bloody premium for it, because we want to have a higher rate of interest for you to compensate us for the fact that you're riskier. So that's what this paper finds. So I think then this is my last slide. There's one paper which is closely related, which I think you urge you to look at. It's by Papuzzi, Piazzesi, and Schneider, again, some Italian authors. And it's how unconventional is green monetary policy. It also deals with financial frictions and climate externalities. It does look at the first best first, and then derives the optimal portfolio. And then it looks at the market neutrality of asset purchases. And amazingly, what they find is that using microdata on bond holdings, that the ECB's corporate bond portfolio is actually slanted towards brown assets and not to green assets. So what does this mean for all the warm glow for the green of Madame Lagarde? So this paper is very exciting. So I urge you to take that into account into your own discussions. So finishing off one sentence, it's a great paper, and I given that you've got it all in place, I would use it for other more interesting questions. Some of those I just outlined. Thank you.
Rick, thank you very much. That was a really insightful and also practical discussion. So, Francesca, would you like to spend a couple of minutes kind of reflecting and responding to what you just heard?
Of course, that will be difficult in a couple of minutes because Rick gave me material for the next 10-year research. But yeah, I will try my best. So estimating the model, of course, I'm aware that there are several techniques. We have these on our agenda, even for a follow-up paper. So I agree on the necessity to look at second moment. But consider that in the paper, then we look just at these financial shocks. So we don't model other shocks in the paper. So I agree that will be better and will to make the model more robust. But
it's not just a question of that. It's also that the second moment define the risk, and it's really all about risk that this financial policymakers are concerned about.
I agree. Consider that we didn't include this in the paper yet, but we check for the second moment regarding output, energy, investment, consumption, and all the volatilities there. But we didn't include this in the paper because we don't look explicitly at other shocks. Climate model, we had this in a previous version of the paper where we model climate damages and global warming, but we now calibrate the model on the euro area to better target central bank's policy. So for us would be, it's difficult to model a proper climate model if we have just the euro area in the paper. That's my intuition, even considering the steady state nature of the model. But if you have better suggestion, I will be happy to discuss this with you, Rick. We can run stochastic simulation for better understanding the nature of the green capital requirement policy and capture this increase in the risk that you are suggesting. So we can do this via stochastic simulation, not just impulse response function. What else? We can also discuss how different authority can tackle different kind of friction and risks. My last point is about the policy scenarios. You define this policy a bit ad hoc. I'm not convinced that they are ad hoc because we have this certified percent emission reduction, and this is in accordance with the European target, right? And also our baseline mitigation scenario implies that the carbon price grow at the interest rate, so around 4% per year. So in this sense, I wouldn't define this random, but I'm also happy to discuss if it's possible to model a proper cap on cumulative emission. And I think that's it from my side.
Thank you, Francesca. Actually, we have a question from Irene Monasterolo. So Irene, would you like to ask your question if you unmute yourself?
Yeah. Francesca, thank you so much for the presentation. It's absolutely interesting. And in particular, you consider different types of policies that could be implemented, going beyond a carbon tax. I have a question about how you treat investors' response. So we know from recent literature that investors' expectations towards the same policies actually could largely affect the outcome of the green policies themselves and could potentially also revert them. My question is, to what extent, if any, your model is looking at these, or if you have any comments on this point?
Thank you so much. I'm also aware that you look explicitly at this in one of your papers. Here we rely on the rational expectation assumption, so the agents are completely forward-looking in the model. In this sense, they are able to internalize the policy and they react in an optimal way. We are also a working paper forthcoming where we look explicitly at different kind of beliefs. So we observe what happens if you, for example, remove this assumption about fully rational agents. And you can see that the mitigation pattern is frustrated when you remove this forward-looking assumption that we have here. So it's a very interesting aspect to analyze. It's not in this paper. Here we have just forward-looking agents, but we are doing research on this aspect. Thanks for the comment and the question.
No, that's very interesting because it means that also across different type of models, this still
consistent, right? Yeah,
yeah.
I agree.
Very good. Let me pick out a couple of the questions that our audience members have asked, and maybe you can give your comments on those. So the first is by actually my colleague Tim Foreman, who asks if you can motivate the financial shock to fossil energy with specific climate events that may change beliefs about the profitability of that sector. You can read the full question on the screen. And
yeah. In the paper, actually, we give a bit of motivation about this shock, and we also talk about potential change in market sentiment following an acute climate event or climate change disaster. But you know, the range of events that we could model is so large that we how can I say, we adopted this shortcut of directly modeling the valuation of fossil assets. But yes, we also talk about this a bit in the paper. We don't model climate risk intended as climate change events. That's true.
Okay, so the second question, this is from Mohammed Al-Nazir, who I guess he's asking about the European Central Bank's asset purchase program, so its QE program, and pointing out whether there, are there sufficient highly rated green assets out there for the central bank to purchase, to implement its monetary policy that way? What are your views on that?
Very good point. My view is that the green sector at the moment is not large enough, and in the sense that, of course, we put this 5% shock in the model. We do not want to have any claim about the impact and the size of this financial shock, but I'm aware that targeting just green assets could be not sufficient if we don't have a proper development of this sector. And I agree that asset purchase program mostly targets so far the government bond and not green or brown assets. I would say that it depends on the size of the sectors and the size of the potential shock.
Very good. The next question, this is from Yao Dong, who asks, see if I can give you a précis of this. I think his point is that, if we were to go down the route of penalizing brown, adding a kind of a penalizing capital requirement for brown assets, that may kind of coincide with a bunch of other things that are happening, like carbon taxes that are also trying to target that externality. So is there a way of disentangling those two? Is it better to keep capital requirements neutral? He didn't say that, but I'm reading between the lines.
Of course, in this paper, we just focus on this macroprudential nature of the instrument. And if we adopt a macroprudential perspective, then my answer will be in line with Rick's discussion that penalizing brown assets would be better. If we want to address the issue from a transition perspective, so if we want to discuss which instrument is best in driving the transition, then the story is a bit different. I think Irene has a nice paper on this when she looked at both green capital requirement and carbon tax, and you can see there the combined effect of different policies. We also had in a previous version of the paper a carbon tax plus a subsidy on green firms, but then due to the focus on stranded assets of this paper, we removed this experiment and we decided to adopt a proper macroprudential instrument. So the two dimensions, transition and macroprudential dimension are very interrelated, and it's not so easy to distinguish and to, the border, what is what in this case.
Let me, I'll use the chair's prerogative and ask you a couple of questions myself. The first one is about stranded assets, and I was wondering whether there's a way of like capturing the notion of stranded assets in your framework. You have bank capital requirements. Could there be a way of like writing off some of the assets on banks' balance sheets and looking at the dynamics that might generate? I think that could be quite interesting. And then the second one, this echoes something Rick said, but I would find it very interesting to look at like a welfare perspective, optimal policy in your setup. So it seems like you have all the ingredients you need to do that. So, the question might be something like, how different would a Taylor rule look like, taking into account these climate factors? Presumably inflation is going to be more volatile. Do you need to lean against inflation more? What's the kind of advice for monetary policy makers from your model? And I think you could do the same thing on the capital requirements side. So for financial stability policymakers, how should one vary the countercyclical buffer differently, say, taking into account these factors? I think they would be very, very interesting questions, I think.
I totally agree. Probably to model in a proper way the stranded asset story, you will need to model explicitly default if you want to put more attention on the financial side of the story, right? To me, this one is mostly a macroeconomic model. So via this Gertler-Karadi setup, we are able to capture the feedback between financial sector and macro and the real side of the economy. Modeling defaults will make the stranded asset story more appealing. I agree with this. I see this mostly as an extension of this paper. We have this financial shock, and in our mind that was a shortcut to model this devaluation of financial assets. But I agree that will be interesting. Optimal policy, of course, yes. I would say that adopting a proper optimal policy as intended in the DSG literature is not trivial, consider the model structure that we have, right? So from one side, we are thinking, okay, estimating the model. From the other side, we have this possibility of having optimal policy. Putting both together is really a lot for a single paper. And I agree. I don't know, we also had a look at the welfare optimizing policy. So we ran Taylor rule, a welfare optimizing Taylor rule, not a proper optimal monetary policy, but there the result on welfare was not so, in line with the standard results we would expect, in the sense that the reaction for output was really high, and also for inflation. So we decided to look at standard Taylor rule. So we have an inflation targeting, a Taylor rule calibrated on the ACB, the standard calibration of the Taylor rule, and Taylor rule with smoothing. And then the results are mostly in line. But yeah, maybe more research, we need to do more about welfare. I know, but it's really a lot for a single paper, or maybe I'm biased. I don't know, but yeah, you raised two relevant points, as Rick did, I guess.
Brilliant. Okay, Well, this has been, you've kept time, all of you, perfectly. It's been so impressive. Irene, I hope you're, this puts the pressure on you guys to follow suit in the next session. So let me hand over to our next speaker. So it's a great pleasure to welcome Irene Monasterolo. I'm sorry if I pronounced your name badly. From Vienna University to present our next paper. The floor is yours.
Thank you so much for inviting me today. My name is Irene Monasterolo from Vienna University of Economics and Business and Boston University. And today I'm presenting a joint paper with Stefano Battistone, University of Zurich, and the Ca' Foscari University of Venice. Let's say that with our paper, we complement the story about climate transition risk that was presented by Francesca before, because we focus on investors' risk, and in particular, how investors' risk and traditional financial risk metrics are sensitive to the probability of occurrence and stringency of climate scenarios. This is a particular timely and policy-relevant topic. There was a discussion indeed in recent time on also the Financial Times on climate scenarios used by central banks and financial regulators of the network for the financial system for climate financial risk assessment. And what emerged is that there is still a lot of a lack of clarity and confusion about what these scenarios are and how they are used for climate financial risk assessment. With our work today, we contribute to one side of this debate, providing analytical and computational work to assess this dependency. Briefly, should financial supervisors worry about climate-related financial risk? Based on recent research results, in particular after the Paris Agreement ratification, yes, they should. In 2017, we published a climate stress test of the financial system on natural climate change, showing that investors, both in the US and the EU, so large markets, are highly exposed to what we call climate policy relevant sectors, which are activities that can face losses and become stranded in a disorderly transition. Disorderly transition, as also considered by the NGFS, is a situation in which climate policies are introduced in an abrupt and sudden way with regards to the climate target, and investors cannot fully anticipate their impact. What we found at that time is that over 40% of equity holdings portfolios, in particular pension funds and investment funds, are exposed to a disorderly transition, and the large direct and indirect exposures may trigger individual and systemic risk via price adjustment and considering leverage and interconnectedness, so in a fully fledged financial network model. More recently, we looked at US syndicated loans, US bank syndicated loans, and we found that 2/3 of them are highly exposed to the CPRS, and most importantly is that indirect exposures even increase potential losses by 16%. We recently published a special issue collecting unpublished research on this topic by several actors on climate risk and financial stability. And indeed, research has been very active on this point. But why we do have transition risk? Well, we looked at the investors' exposure to the climate policy relevant sectors, which are a classification of assets by granular NAICS codes, so 4-digit level, that classify NAICS codes of activities into few categories of transition risk based on 3 main criteria: direct and indirect emissions, so scope 1, scope 2, and when possible, scope 3, but also on the policy sensitivity of the activity, such as the cost that the activity faces when the policy change, and also the role of the activity in the energy value chain. Thus, with CPRS, we can overcome some limitation of approaches based only on emissions by considering 2 main dimensions that are relevant in this paper, which is firm's energy technology by business line and the policy sensitivity. CPRS has been used by several policy applications, such as here you can see the European Commission Joint Research Center analysis of the financial risk of the EU taxonomy, but was also used, for instance, by the European Central Bank, Financial Stability Review, and EBA, National Bank of Austria, and so on. However, exposure is not risk assessment. So how do we go from exposure to climate financial risk assessment? Most used models to provide transition scenarios are the integrated assessment models that provide scenarios of emissions concentration to achieve 1.5 or 2 degrees climate target with specific trajectories by type of energy technology, so fossil fuel or renewable energy at a disaggregated level. The use of these scenarios has been, we introduced the use of these scenarios in the climate stress test in 2017, and now they are widely used by the NGFS, which has just produced last year a report on scenarios for climate stress test. What is important to understand about the climate financial risk assessment is the concept of endogeneity of climate risk. Indeed, a successful transition depends on both on government's climate policies introduction and firms' investment decision, but both depend on agents' expectations about the transition themselves, and in particular, investors' expectations on the realization of transition scenarios affect the realization in turn of the very same scenario. And this is an issue that we analyze in our paper forthcoming on Science tomorrow. What is the issue with climate transition scenarios? First, we have two major challenges. The first is that mitigation scenarios don't account for the role of finance in achieving the same scenarios, meaning that investments are assumed to be always available with different technologies, and thus the trajectories don't reflect the impact of financial risk assessment on mitigation investments. The second is that the orderly and disorderly nature of scenario is exogenous, regardless of policy credibility and investors' expectations. This, on the one hand, limits the policy relevance of the scenarios and leads to underestimation of financial risk associated. On the other hand, it opens large place for research and policy relevant research and the need to consider broad range of scenarios for climate financial risk assessment. Knowledge gaps that we address, we see that a better understanding is needed of how climate transition risk affects financial assets and investor financial stability. In particular, we need to understand how sensitive are investors' risk metrics, such as probability of default, expected shortfall, to the probability of occurrence of the disorderly scenarios, which are the risky ones. And why? Because this is crucial for climate financial risk supervision and risk management strategies, but it's still missing in the literature. So here we come to the contribution of the paper, economic intuition, where does risk come from? If markets price efficiently forward-looking climate risk, meaning that high carbon firms are more risky than low carbon firms, and anticipate then the climate policy impact, transition risk would not be financially relevant. However, we still have no clear signals of anticipation of forward-looking climate transition risk, which is not only emissions. The friction in this case is that deep uncertainty on climate transition scenarios, the probability of occurrence and their impact means that agents are not able or willing to fully internalize the information on transition risk. Furthermore, investors' expectations are subject to herding dynamics, and a stampede then can occur unexpectedly in relation to the introduction of the policies. For instance, this is what has occurred also in 2008. Thus, the adjustment in investors' expectation about the future transition scenarios can lead to a revaluation both of securities in CPRS, both negative for high carbon firms, but potentially also positive for low carbon firms. And indeed, issuers can vary the share of the investments in low and high carbon activities, and investors can vary the portfolio composition across issuers. However, given the uncertainty of what could happen, both on the policy and investor sides, there are gains and losses that cannot be fully anticipated. Outline. In the business scenario, investors allocate capital to low or high carbon assets to maximize a utility. Let's say, for instance, mean variance. We have then an adjustment in investors' expectation that results in the valuation adjustment of corporate bonds and thus in an investor probability of default. Here, with analytical and computational work, we study how investors' PD and expected shortfall adjustment depend on the interplay between the stringency of climate transition scenarios, so the disorderly scenario in particular, and the initial share of high or low carbon assets in their portfolio. Main results and then we go to the briefly to the model and graphical results, we find that the probability of default and expected shortfall of a leverage investor increase non-linearly with the impact of the climate policy shock on the revenues of corporate bonds issuer in low or high carbon activity. Then the PD of a leverage investor is sensitive to small changes in the adjusted bond PD, to the probability of occurrence of a disorderly transition scenario. Furthermore, investors' PD can be highly sensitive to the choice and probability of occurrence of transition scenario, and thus, considering adverse disorderly scenarios in climate stress test exercises contributes to mitigate the impact of uncertainty and underestimation of risk. Model. Our investor disposes information about 4 types of scenarios. The first disposes the information of a set of climate policy scenarios P that correspond to greenhouse gas emission reduction targets, for instance, the 2 degrees target, across regions, versus B, which is the base, so in the scenario in which we don't have a policy. Then we have a set of economic output trajectories for each economic sector of activity, country, and scenario and policy scenario, which are estimated with a given climate economic model, in our case, the integrated assessment models, process-based integrated assessment models. Then we have a set of forward-looking disorderly transition scenario. So what happens when we translate from a B, so business as usual, baseline policy, to a policy scenario, and a set of climate policy shocks, which are the differences in economic output for each sector, which could be high or low carbon, we're moving from B to P. And this is estimated with different types of integrated assessment models, M. Then we decompose the shock on the revenues of the issuer J, with the UJS being the relative shock on the sectors, which could be high or low carbon, and WJS is the share of J's revenues from each sector. So in this case, we treat a firm as a portfolio of business lines, high carbon and low carbon. In particular, we focus on 3 CPRS, which are those most relevant for stranded assets and the transition. So primary energy fossil, electricity production out of fossil fuels, such as coal, oil, gas, and renewable energy, wind, solar, biomass. The impact of the transition scenario BP on the revenues UJ results in a shock C on J's assets with which are connected with elasticity key. Few remarks. Our firm is considered as a portfolio of low or high carbon activities, and this is what happens in the reality. For instance, Eni, the Italian fossil fuel companies, has also a renewable energy branch. In a disorderly transition, low carbon activities will have gains and high carbon activities will incur losses. The shocks on the revenues of the issuer can be approximated as the revenues of the firm can be approximated as a shock on the output of the corresponding economic activities, depending on their energy technology. And which transition scenario will occur is uncertain and endogenous. Here we have a definition of the corporate default. So we have defined the default condition in a structural model in discrete time, but of course can be run also in continuous time, where we have eta, which is the idiosyncratic shock, which is a traditional idiosyncratic shock, such as a shock on firm's productivity. And then below, we add a policy shock, C, which is conditioned to the type of transition scenarios, in our case, type of disorderly transition scenario, and shifts the threshold of default. Here we go on results. So then we calculate, we consider a leverage investor, and for our leverage investor, we calculate the climate value at risk, which is the value at risk of the portfolio of investors I, conditional to the transition scenario that we consider, and then the expected shortfall, which is the average of the losses above the VAR, and this is what we consider in our results. We prove several propositions, so if you are interested, we have the paper. and briefly on the last 3 slides of results. First, we look at how losses on the corporate bonds portfolio depend on Q and P, being Q the default probability of the bond, and R, being the default correlation. Let's look at the left figure. So we see that the probability distribution on the y-axis of the losses on the x-axis in percentage on an example portfolio of 100 bonds, which is equally weighted. So we consider the simplest case for this analytical and computational proof. What we see is that the climate expected shortfall, which is represented by the vertical bars, moves to the right, both with the increase in the bond default probability Q, indeed in the top we have 5%, in the bottom 15%, but also with the default correlation rho, which is the color of the bars. Important, Q depends both on the energy technology profile of the firm, so high or low carbon, and on the climate transition scenario. Second, how wrong could our investor be if she neglects the adverse climate transition scenario? And here, what we see here, we have three potential scenarios. We have the magenta scenario, which is the scenario estimated by the investor. So the investor believes that this scenario could realize, this transition scenario could realize, but in the end, maybe a red point, so a more stringent disorderly scenario could realize. What happens is that there are large differences then between the estimated and realized scenario, considering different levels of rho on the expected shortfall, but even larger discrepancy on the probability of default because of the leverage. Finally, what happens if our investor underestimates the probability of the adverse disorderly scenario to occur? I will go straight on the right part of the figure. Here, what we see is that if we have again our estimated scenario, our chosen scenario by the investor, which is the magenta one, and our actually scenario that realized, which is more adverse, which is the red dot. What we see is that the adverse scenario occurs with a probability, which is PA. And here we see a big effect in the discrepancy on the probability of default of the investor if actually the probability of occurrence of a more disorderly scenario increase from actually 5% to 40%. And the difference in the probability of default of the investor is between 1% and over 7%. This means that it's important to consider a wide range of probability of occurrence of disorderly scenarios to tame the uncertainty that is related to those scenarios and thus to mitigate loss underestimation. Conclusion, in this analysis, we developed a model to compute the valuation adjustment of a corporate bonds of investors' PD and expected shortfall, depending both on the transition scenario and on firms' shares of low and high carbon revenues. Our model provides an operative framework that can be applicable with several types of macroeconomic models and climate economic models. Our research has some important implications for climate financial risk management, and in particular for climate stress tests that should allow for a wide enough set of scenarios, including highly disorderly scenarios, to limit the underestimation of losses. And this has implications also for financial supervisors to monitor and tame possible investors' moral hazards and implications on financial stability. Thank you.
Irene, thank you very much. That was a super presentation. Your discussant is Paul Hebert. So Paul is at the European Central Bank, Head of Systemic Risk and Financial Institutions Division, no less. So Paul, your slides are up. I can see you've unmuted yourself, so the floor is yours.
Thanks, David. And thanks for the invitation to actually join the very interesting conference and be at the tail end of the conference, and hopefully still keep your interest peaked for this. I, of course, have a disclaimer, I think like many others have had. These views are my own. So let me push forward with first a summary of the paper. So there we go. So my impressions of the paper, I think I try to distill as best I can. I think Irene obviously did a more comprehensive version, but the key elements to me were basically three. So first on the model. So it's a climate value at risk model, clearly, and therefore it's about market risk. And this idea of prospective portfolio losses and adverse scenarios. And here I think it's important to note that the losses are associated with surprise climate-related risks. So in a sense, efficient markets hypothesis should reign, and does, I think, in this framework as a founding principle. The general finding, of course, within this model is that climate-related risks are not reflected in financial assets. I think that would be consistent with what we see in terms of micro-evidence on market pricing. Could be either informational or allocative market failures characterizing climate-related markets. It's plausible to think also that markets might then abruptly price in this risk, and some of the shocks would be inherent in the scenarios, of course, very relevant here. So that's about the model. On the metrics, so there's asset level and portfolio level metrics. The asset level, of course, as Irene mentioned, is about corporate bonds. That's the focus. Default probabilities are backed out with a valuation adjustment in a Merton model spirit. And the portfolio level idea is you build up to an expected shortfall. So the market risk of a portfolio is quite important, of course, for many financial intermediaries at the moment. So certainly very relevant in a timely piece in that respect. Shocks. So the last part is about what are the shocks that they're running through these models. Basically, it's about climate shocks in the scenario sense. So it's adapted NGFS, network for greening the financial system, distributed to granular sectors through an elasticity coefficient. And the idea is that, of course, these activities are basically about sectors vulnerable to pricing. So this idea, you have emissions that are direct or embedded, policy changes or role of activity. So with this in mind, and a description of the model, just a quick word on the results before I turn to my views. And the threefold ideas of the results are there. I think Irene summarized it, so I'll be very brief. Nonlinear impacts are there, of course. So the metrics in the last slide I mentioned are nonlinear function of the climate policy shocks. Sensitivity is there, of course, both at the asset level with bond default risk, portfolio level, of course, with particularly adverse transition scenarios. And the practical tool, I think, which is nice and is moving from uncertainty to risk. That, of course, if markets have not priced in climate risk, this does give them the opportunity to think about in a sort of more Knightian uncertainty sense, or climate may be a very difficult one to tackle. As this gives us a practical means of actually bringing this into the purview of risk in that sort of realm, which is helpful, of course, in trying to plan forward shocks. So with that in mind, I think the nice features are obviously it's a benchmark one. Irene mentioned it's in principle scalable. It can be enlarged to encompass other assets in a climate-sensitive portfolio. It's also secondly granular. Here there's activity level considerations within sensitive sectors. Third is, of course, the idea about the systemic aspects which are embedded. Climate is clearly a systemic issue, not just institution-specific. For market risk, at least, we have the correlated shocks feature here. And fourth is about the forward-looking aspects of these natures. And indeed, climate is one of those elements where the past is not particularly good guide. And often value at risk frameworks, not this one, but the generic framework, are often criticized for this, that structural breaks are very hard to accommodate. So this forward-looking nature that they've baked in is very helpful for the climate question, which could be arguably quite, one slide too far, which could be quite novel in many respects as we move into uncharted waters. So with that in mind, I just wanted to mention one last thing before I turn to some comments, which is it does fill a measurement gap. And I wanted to share with you this image from the Basel Committee on Banking Supervision report published in April. And it had an overview of measurement methodologies of banks and supervisors. I was co-editing this work. And I think what's important to know with the three blocks reading from top to bottom is risk identification, I think, in our view, was relatively clear. And we're able to do that quite readily now and understand the channels. The second block reading down to the middle here is really about the measurement in terms of mapping, exposure mapping. And that's also a lot of progress there. It's the third block, I think this is where this feels a key gap, is about actually backing out financial risk. What are the financial risks there? And in a sense, what we've found so far is that mainly banks in particular, but also financial industry participants have focused on credit risk above all. And of course, market risk is one of those areas which needs much more work. And that is something this paper nicely does. So in terms of the comments, I would have 5. So the first one is really about this concept of granularity. And I think here it's important to note climate-related questions. The devil is really in the detail. And it's not just a heat metaphor for where the devil resides, but really it's about the details which do matter. So in the question of granularity, the first one, there's very different ways to tackle the paradigm of granularity. Depends on the question being asked. And firms are labeled green or brown often. Actually, in the last paper before this, that was that type of notion. But in the firm level is relevant, but sometimes activities are relevant. You drill down. So this paper obviously has looked at activities in sensitive sectors. And this table here just gives you an idea of what the sensitive sectors are and how they're mapped. Now, what's important to know for our perspective is sometimes firm level questions can be important too. So what we found as we've delved more into the climate issue here at the ECB is that it's not just across sector heterogeneity that matters, but it's also within sector heterogeneity. And I guess a key question here is, are these climate policy relevant sectors as identified sufficiently encompassing to capture the full remit of firms which might be under difficulty? And what you see basically from this is a box plot just across the NACE industries. And basically what you find here is that some of them, like electricity, mining, or manufacturing, are obviously much more carbon intensive as a general rule than trade or real estate or other. But what we have at the firm level, of course, is if you see the huge dispersion around this box plot. So we see that quite some companies manage to conduct their businesses in a much more efficient, intensive way than others. And it could give scope to market repricing. And we've tried to basically back that out through some also interconnectedness contagion models and find that you could have some kinks in perceived credit risk as ratings agencies come in and look at, and arguably rating agencies are doing this, looking at the emissions intensity and other factors of firms in their ESG scoring, also with a forward-looking dimension, which could lead to a credit re-rating and therefore a kink, say, in the pricing function, whereby there needs to be some indiscriminate, some potential offloading by institutional investors. So stress factors we have in the left, you see us here, we're just mapping them at the sectoral level and taking a proportion of those and then putting them into bank holdings in an interconnectedness model and see what happens. And lo and behold, you do see that there could be some banking sector exposures which experience losses here, and particularly in the tails of the high emitters. The other point, which is quite interesting to note on the granularity question before I leave it, is this idea of the climate stress test we've been implementing here in the last months, hopefully publishing mid-year, where we have a long 30-year horizon. We do look at physical and transition risk across 3 different scenarios of the NGFS. And basically what we see are the cross scenarios, which are the bars, the colors here, the red, orange, and the yellow, in terms of limited physical, more physical risk transitions, or hothouse world where you have physical risk completely unabated. It is more important to look at the diamonds maybe than the bars, which is not for the median firm, but for the high emitting firms seem to be far more impacted by climate transitions than the average firm. And that's irrespective of the industry. And sometimes some industries you might find a bit surprising are partly in this feature. And I've listed the reference below for those who want to have more on this. Second comment after granularity is about scenarios. And the paper rightly focuses on the dependence of financial risk on the probability of occurrence and stringency of climate transition scenarios. Of course, those scenarios are not completely dissociated from other scenarios of potential physical risks. And this paper is obviously very narrowly looking at transition risk, which arguably is more on the minds of market risk questions of financials at the moment. But of course, we've seen some papers like ones in the Review of Financial Study last year of Alok and co-authors, which talks about a salience bias. Much like COVID, shocks are often that are long dated, existential threats are neglected by policymakers and ignored by investors because of intangible or remote potential elements before they strike. And the salience bias might imply potential nonlinearities, which are catered for by the model, but maybe not by the scenario. Last points to round out the 5 is about financial risk metrics. Of course, market risk is one element. You could think about other credit, liquidity, operational, even reputational risks, which tend to be problematic now. Obviously, they've looked at some flow questions. So in the revenue, the emission scope questions, scope 1, 2, 3, is it an input to production? Is it what you produce in emissions? Or is it the downstream emissions intensity? So you have a diesel car and the like. We'll also have differential impacts on revenues or costs of a firm. So be interested to know about that differentiation. The stocks in terms of debt and technological substitution are, of course, covered, but it's also interesting maybe to differentiate those. Portfolio level, of course, I list a couple of studies here. I think what's nice is this idea that there's not an aggregate VAR evaluate risk, but it is indeed one which is more granular. Last points, just quickly before rounding up, other forms of endogeneity. You can maybe think of 3 different ones. The real financial endogeneity, the endogeneity also with respect to climate feeding back onto financials, but also actually it's the other form which I think is more important. So this gives you an idea of real financial and physical risk. But what Irene mentioned in the companion paper I think is quite interesting, is this idea of dual materiality. So firms are not just exogenously in having climate risk affect them, but their lending behavior also impacts climate itself. And that dual materiality, perhaps not exactly in this paper, but it's something I've understood in as in the companion paper. It's those feedbacks which really make this a systemic shock. Lastly is about assumptions. There's a lot baked into this slide. I maybe just quite walk through that quickly. Initial conditions are important. What we're seeing is a much more of a focus in the climate world about forward-looking disclosures of firms. What are their targets to get to net zero? What is the path to get there? So that would be nice to the extent it's possible to bring that in. Of course, there's a lot of greenwashing in there, but it's something to very much consider in terms of the data questions. And again, the devil in the detail, data has been really a challenge for all of us in this climate space as firms start to disclose more and better. I think the last block is perhaps important on the bar, and I'll maybe just single out the discount rate question. Of course, arguably discount rates really do matter a lot, and we're looking at climate VARs. I think the discount rate you're applying to potentially elongated shocks is quite important. I had a bit of difficulty backing that out, as if I'm to pick anything out of this. But of course, there's other standard questions about value at risk, which I think are quite standard issues. Some of them have been tackled with different degrees of stringency. So in summary, I really like the work. I thought it was very well executed, very relevant, timely. I think this idea that it's an industry standard again can bring us out of uncertainty realm into risk, probabilistic risk, in a forward-looking way. Comments are there. Happy to hear any views, and definitely I'm interested to hear the discussion. Thanks, David.
Paul, that was wonderful. Really insightful. Thank you very much. Irene, would you like to take a couple of minutes just to respond?
Yeah. First of all, thank you so much, Paul, for such rich comments. Again, also here I could produce other 2 or 3 papers at least. Let me just reply to a few points on which we are already working, and then, well, probably the next ones when we will develop future papers. With regard to firm level granularity, indeed, we have already, we have further developed the CPRS classification, and we moved at the firm level, meaning that now we have a database for over 10,000 companies, considering the revenues of the revenues from high and low carbon activities, and mapped in different value chains. So this is already something on which we worked. We developed the classification of this new CPRS granular will be out soon. We have already the CPRS 1 and 2 classification available online, and we will put this more granular one out soon. With regard to the extension of the model, we are going to consider also physical risk scenarios and thus this tailoring the model application. And we are also connecting this framework to the macro-financial model, and in particular the Ehrmann macro-financial model that we have been using to analyze the macroeconomic and financial impacts of different types of climate policies. I will also take the comments of better specifying in the paper the characteristics of the bar with regards to distribution and so on.
Lovely. Before we turn to the Q&A, so if any members of the audience have questions, do please post them in the box. I do know that both Rick and Francesca have questions for you, so I don't know if you'd like to switch your mics on and ask your questions directly. Francesca, would you like to go first?
Sure, thanks. My question goes beyond this paper. I will be curious to have your opinion on how to reconcile the long-run nature of climate scenarios provided by integrated assessment model with short-run analysis. For example, if we think about the time horizon of monetary policy, then there it's really difficult to come up with scenarios that we can adapt to business cycle models, right? Even because integrated assessment models, think about the Remind model, are based on 5-year step optimization procedures. And to me, this is really challenging if we want to translate these scenarios into monetary policy analysis. Do you have a perspective or opinion on this? Thanks.
Thank you for this question. It is indeed very interesting. So all process-based integrated assessment models that are considered by the NGFS and that we are considering here have a 5 years indeed time scale. So we use the shock every 5 years to characterize our analysis. However, in the context of physical risk, we are using a different type of approach where we couple chronic risk and acute risk, meaning that the scenarios of shock are much more granular. With regard to, and this is an approach that we have been developing in a project with the World Bank on compounding COVID and climate risk. With regard to transition risk, we actually so far took two different, we are considering two different ways to address this issue. One is to consider event studies, so announcements. And the other one is to actually try to downscale these model results, climate economic model results, to a shorter time scale. But we are still working on this. And it's indeed a big research issue.
Thank you.
Thank you. And Rick, do you want to ask your question?
Yes, one is related and the second is not related. The first question is, many of these risk questions are really like transition risk questions, or questions about the next few months or few years or something like that, or maybe even longer, maybe 10 years. I don't know what kind of, but I think your climate stress analysis, because of the models you're using so much as exogenous, are really more a short-term analysis. What's your view on that? Maybe I've got it wrong. Related to that is the question about networks. I know you worked on networks and your co-authors have worked on networks. So I often wonder if these tests, can we make those networks more resilient, these networks of banks, these networks of companies? So in a way, we often take, in your work and in your collaborators' work, you often take the nodes of the network as given. But of course, you may want to change policies to make it a more resilient banking system, in that you try to make the whole banking system more resilient to kind of particular physical risk and particularly transition risk. So could you reflect on that?
Yeah, so it's very rich set of questions. So, so the second one is on the evolution of network for resilience. And sorry, could you repeat the first one?
First question was more about the time scale you're thinking of for your analysis. Like normally when you think of physical risk, I may be worried about the next 20, 30, 40, 50 years. If I worry about transition risk, I may worry about the next 5 years. Yeah. But I think your climate stress testing analysis hasn't got much endogenous behavior. In that sense, it's the opposite of the work by Francesca, who has a very carefully specified model where the prices are endogenous, unemployment is endogenous, exchange rates are endogenous, and yours is more, almost like a, well, maybe partial equilibrium. But I don't want to put the answer in your mouth. Could you reflect on that?
Yes. So thank you. Yeah, this gives me opportunity for clarification. So the paper that I'm presenting today has nothing to do with the climate stress test strictly. So it's an asset pricing model. So it's more related to that. So we, while the climate stress test of 2017 and its most recent developments like 2021 with the NEVA approach are based on financial network models. So here we consider timescale for transition risk of 5 years, which is when we have the output shock from the integrated assessment models, and indeed for transition risk. And indeed, this is reconnects to the issue, to the question by Francesca before. So with regard to the network model that indeed we further developed and we applied recently both to transition risk for the US banks and the Mexican financial system was published in Journal of Financial Stability this year, and physical risk again for US bank, and it's forthcoming suppose at the beginning of July. Actually, this is not properly true that it's everything exogenous and the network is fixed. It's true that we take a snapshot in the tradition of stress test, the top-down stress test, and we look at what is the potential risk that investors would face given a certain composition of their portfolio at a point in time. However, we have worked, and this is a disclaimer on ongoing work. We have been working in the last year to make it dynamic by connecting it with my macro financial model, the model Adrien, in order to be able to feed back economic and financial dynamics in response to both exogenous and endogenous shock. This is what's going on, but we expect to have first results not earlier than by the end of the year.
Well, okay, we have a, apologies, there's a huge thunderstorm outside, so if you hear a big crash, that's what the sound is. We have 3 questions from the audience, which I'll maybe pose to you and you can kind of reflect on briefly. The first by Tim Foreman. I think he's asking whether you could expand a little on the nature of the disorderly transition shock that you think is most likely or that concerns you most. Is it something that's related to investor inattention, that suddenly kind of, people suddenly wake up and realize the scale of the issue? Or is this something more to do with policy, coordination, or information cascades? So what are your views on that? The next question by Salman, I'm afraid I can't pronounce your surname, Salman, is really asking about the kind of dependence of your results on integrated assessment, on the particular integrated assessment model you're using, and what you can say about sensitivity, I suppose. And then Anastasia Aliotti asks, I think, a question about the kind of distributional assumptions that are being made in the background in your work, and whether you can account for issues like skewness of outcomes. Why don't you reflect on each of those, if that's okay? Okay, thank you. So replying to the first question, well, it takes 2 to tango, so it takes also 2 to the transition, I believe, and indeed this is what we consider in our analysis. So on the one hand, the uncertainty on the way in which the climate policy will be introduced, so timing and magnitude, and on the other hand, whether investors, what are investors' expectations about that? So do investors anticipate or not the policy? We analyzed more this issue in another paper, the one that Francesca was mentioning before, but this is the context of the analysis. And for the rest, we consider we take the definition of disorderly transition consistently with that of the NGFS, because it's the most widely used right now. With regard to the dependence on integrated assessment models, well, no, our results are not only the results of integrated assessment models are one part of the framework for the analysis that we developed. However, we consider several integrated assessment models that have different characteristics. And also, we should consider that in portfolio optimization, we have 2 dimensions. One is risk and the other is return.
With the integrated assessment model, and in particular with the change in trajectory of outputs, depending on the transition scenario, we can calculate the expected return. But however, we cannot calculate risk. And this is indeed why we developed our framework. And the third question, yes, the framework can be extended in order to allow for more flexible types of dependence. And you are really, this is right in the direction in which we move towards copulas.